because like in Trump 1.0, they're looking for carve-outs when it comes to tariffs.
The Wall Street Journal wrote an editorial over the weekend, and the first line of it I thought was applicable to a lot of different announcements and things we've been hearing. The Trump administration is moving so fast, it's hard to know what's real and what is a media panic. It is hard to know what is actually concrete and different from before versus something that is simply signaling. And I think that is what we're going to be trying to figure out for a while.
There's always a lot of media panic. Always.
Always.
There was 8 years ago, right?
Yeah. Well,
panicking about just about everything.
Right. And so at this point, it's hard to know what's real and how much this is actually going to be carried through on all sides, whether it has to do with job cuts, whether it has to do with investments.
We're going into week 5. Just week 5. The way people talk about it, it's like we've been doing this for months. It's week 5. Coming up on the program, Matt Stuckey of Northwestern Mutual looking ahead to NVIDIA results. We'll catch up with Henrietta Treyz of Veda Partners on the odds of one big, beautiful bill and the former senior advisor to President Biden, Amos Hochstein, on securing peace in Ukraine. We begin this hour with stocks looking to recover their worst day of the year. Traders awaiting NVIDIA earnings on a Wednesday and core PCE on Friday. Matt Stuckey of Northwestern Mutual writing, mega caps are plowing into AI. It's a big tailwind for near-term economic activity and long-term productivity. Matt joins us now for more. Matt, welcome to the program, sir. Is it a big tailwind for NVIDIA?
Well, it certainly is. And if you're looking at kind of what hyperscalers are spending money on, it is NVIDIA chips. And so, ratcheted up CapEx expectations as you look to 2025 and what's been happening in the last few years has kind of falling directly into NVIDIA revenues, and we expect that to continue.
How crucial is the NVIDIA report on Wednesday, Matt, to really give fuel to this story that we've seen about big tech really being the center of the AI dreams and hopes and continuing its meteoric rise?
Well, it's a large piece of the S&P 500, as you know. And then when I came in this morning, I was looking at the eco function on my Bloomberg terminal. I didn't see the NVIDIA earnings report listed there, but it might as well be on that number just in terms of its importance in the U.S. economy and its overall kind of impact and what separates the U.S. economy from the rest of the world. In terms of kind of the earnings story of the United States relative to the rest of the world, it has been driven by big tech, and NVIDIA is a huge component of that.
Matt, just more broadly, we started this show on a pretty bearish note, people talking about what happened, people meaning us, what happened on Friday with some stagflationary data in a sense that momentum was hitting the pause button. How much do you see this as just sort of a momentary blip versus a real shift in narrative that's affecting how you plan to position going forward?
I think, Lisa, I would classify this more as churn versus trend as it relates to kind of what we saw in late last week. And really, if we're kind of on lookout for sources of corrections, really there's two I would point to. One is a ratchet up higher in interest rates or a ratchet up higher in unemployment. With the labor markets, somewhat resilient here, and the forward indicators, whether you're looking at small business confidence, the Conference Board hard easy numbers, or overall just the consumer spending profile, which has been firm, outside of kind of some softer retail sales in January and so far. Looking at what's left in terms of correction possibilities, it's interest rates is where you're looking at. And in my mind, if we have a little bit of a softer start here in Q1, I think that helps kind of keep the interest rate kind of upside breakout potential somewhat more muted. And to me, so this is kind of more of a consternation, more of a churn dynamic versus more of a trend, if you want to call it that. Just looking ahead, I would say, January, again, you look at one of the coldest Januaries we've seen in more than 130 years. I think that really impacts some of the spending numbers and some of the softness we've seen so far.
Matt, there's a note this morning from an analyst about Microsoft that they think will be canceling leases for a substantial amount of data center capacity in the United States. That begs the question, and potentially, are you cautious about this, about the outlook for demand when it comes to AI? NVIDIA to me has a large list of customers, Microsoft's being, a big spender in the AI story.
But look, in terms of kind of what else is out there in terms of the overall kind of investment, we've heard from Meta, we've heard from Google, we've heard from Amazon, ratcheting up CapEx expectations, and the announcement this morning from Apple also confirming their desire to continue to build out AI compute capacity. Of course, you're always kind of looking at the risk that there's some cyclical correction in terms of AI compute demand if, for whatever reason, we don't see the follow through in terms of productivity enhancements roll out to the broader set of the economy in the coming years. But as it stands today, the checks into the NVIDIA quarter were very strong, and the product transition moving from Hopper over to Blackwell seems to be kind of moving forward fairly well.
Do you think there is still, though, this nervousness or angst in the AI space when it comes to what China is doing, the money that they're throwing at their AI development?
I think that it's certainly a risk that's out there. It's not as much of a direct risk, though, for NVIDIA's revenues. With export restrictions that are in place for U.S. semiconductor companies selling into China, higher competition there means that U.S. companies also need to be aware of that competition and spend more on their own AI roadmaps to compete with China. To me, I don't think that's necessarily a direct negative for the overall kind of AI story. It just means that there's more competition, which to me means more spending.
Hey, Matt, appreciate it. Looking ahead to those earnings on Wednesday. Matt Stuckey there of Northwestern Mutual. NVIDIA results drop in on Wednesday after the close. Look out for that. Data-wise, looking out for jobless claims later this week and PCE, the inflation read for the Federal Reserve on Friday. Got to pick up on this bond move, though, over the past 6 weeks or so. 6 consecutive weeks of falling 10-year yields. And I'll go back to that question that Chris Verona strategist asked on this program in the last few weeks. The lower bond yield supports cyclicality or suggests growth is slowing. On Friday, I think we got a definitive answer for that session alone.
Which is unfortunate when paired with this sense that maybe inflation is going to be a bit more sticky, which is the reason why you're seeing yield curve flattening. And if you get that continued sense, it is absolutely a negative thing for a lot of equities, which is what we saw with the Russell 2000.
The complete opposite of what people were expecting closing out 2024, kicking off 2025. Yields down every single week of the presidency so far. Not up, lower.
This has to do with 2 things. First of all, we're getting some of the tariffs and some of the less growth-focused policies from Donald Trump to start the year. We also are just entering a later cycle of this economic period. But then on the flip side, there's a real question here of what some of the offsets will be, what some of the investments will be, and how much people can make those given some of the uncertainty. Bond
yields just a touch higher this morning, up by close to 2 basis points at the front end of the curve. Let's call it 421 on a 2-year yield. On a 10-year, just about unchanged at 444. Let's get you an update on stories elsewhere with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Ukrainian President Volodymyr Zelensky said the U.S. dropped its demand for Kyiv to pay $500 billion to compensate for prior U.S. support. That demand had been part of the talks to give Washington a cut of Ukraine's mineral wealth. Zelensky insisted, though, that U.S. military support must be part of any deal. He went on to reject the U.S. argument that American companies doing business in Ukraine would serve as a form of security guarantee. Over at UniCredit, the bank is increasing its bonuses for top managers after a record year. People familiar say the bonus pool for so-called material risk takers will increase by 11%. The Italian lender is also planning to raise the average bonus for staff by 20%. Researchers at the Wuhan Institute of Virology in China say that they've discovered a new coronavirus in bats that enter cells using the same gateway as the virus that caused COVID-19. According to the journal Cell, the finding raises the possibility that this new virus could spread from animals, though it has not yet so far been detected in humans. And that's your brief, John.
Danny, thank you. Appreciate it. Kinda, with the exception of the last story. How many people turned around on Friday and over the weekend when they read this for the first time and just said, nope, not doing that?
Literally, that's exactly what I was going to say. My oldest son turned to me, he's like, if there's another lockdown, I'm not doing it.
Close the laptop, don't want to read about it, don't want to hear about it.
Not having anything to do with it.
Basically, we can't do this again, and the market was saying, well, maybe we should...
Well, we'll talk about it
exactly.
in about 60 minutes from now, so maybe you want to turn down the volume. Jeff Meacham, Global Head of Healthcare at Citibank, joining us on some of the vaccine makers and the latest story out of China. Up next on the program, attempting to secure peace.
Standing here and saying, you're good, you're bad, you're a dictator, you're not a dictator, you invaded, you didn't, it's not useful, it's not productive. And so President Trump isn't getting drawn into that in unnecessary ways. And as a result, we're closer to peace today than ever before.
Bloomberg's Tyler Kendall joins us next in the nation's capital, live from New York. This is Bloomberg.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
So this right here is your bounce back in equities. We're up by about 0.5% on the S&P so far this Monday morning. In the bond market, yields just about unchanged. The 10-year 443.71. Under surveillance this morning, attempting to secure peace.
My question is, does all the finger pointing and pearl clutching make peace more likely? Standing here and saying, you're good, you're bad, you're a dictator, you're not a dictator, you invaded, you didn't, it's not useful, it's not productive. And so President Trump isn't getting drawn into that in unnecessary ways. And as a result, we're closer to peace today than ever before. And I've been privy to these conversations. Great progress is being made. Zelensky should come to the table because this economic partnership is an important thing for the future of his country.
So here's the latest. Defense Secretary Pete Hegseth avoiding calling Russia the aggressor in the war in Ukraine. The United Nations is set to vote today on separate resolutions to stop the war drafted by Ukraine and the United States. Bloomberg's Tyler Kendall joins us now for more. Tyler, it's a new approach from a new administration.
Right, John. Well, it's also the latest example of what has become strange transatlantic relations with Washington. And we could see one of the first meetings here in Washington today from these rising tensions when French President Emmanuel Macron visits the White House. President Trump criticized the French president as recently as Friday, calling him a friend, but saying that he's had a seat at the negotiating table when it comes to Ukraine for the last 3 years, of course, a sentiment that has been met with widespread criticism among our European allies. Now, the French president did preview some of what he might tell President Trump, saying that any concessions to Russia could be viewed as a sign of weakness and that he would tell President Trump, quote, that is not your trademark style. We also know that he is expected to tie what an emboldened Russia in his terms could mean for an emboldened China, of course, another one of the White House's priorities. But John, really, this Trump administration looking for firmer European-led security guarantees, as well as a boost to NATO defense spending. If we keep on France as the example, of course, France spends about 2% of its GDP when it comes to military spending, a number that this White House would like to see higher.
Tyler, we've seen Emmanuel Macron fail in the past with Trump, trying to keep Trump 1.0 in the Paris Climate Accord, trying to keep Trump 1.0 in the JCPOA when it comes to the Iran nuclear deal. What is his strategy going into this meeting today with the president?
Right, but also, of course, we did see the French president invite President Trump in one of his first visits after he was elected to Paris for the reopening of Notre Dame. We do know that the French president is coordinating closely with his UK counterpart, Keir Starmer, who is also expected to be here in Washington later this week, and that we are expecting the pair to put forward that they are ready to up those security guarantees. You heard in that sound played earlier there that this White House is looking particularly for Ukraine to sign that deal when it comes to an economic cooperation agreement and opening up Ukraine in order to be able to get their critical minerals. That is also something that we are expecting to be discussed this week in Washington as these European allies try to push the Trump administration to give forward some sort of guarantee that they will remain in the region moving forward. It's something that we saw became a big point of contention during the Polish president's visit over the weekend when he met with President Trump on the sidelines of CPAC. He did emerge from that meeting saying that he had a sense that President Trump was not going to pull troops, at least out of Poland, of course, the closest ally to Ukraine's border.
Tyler, appreciate the update down in Washington, D.C. Tyler Kendall there in the nation's capital. Here's an update on the latest from Apple. If you are just joining us, some news about 1 hour and 20 minutes ago that Apple will hire 20,000 new workers and produce AI servers in the United States. The company planning to spend $500 billion domestically over the next 4 years, including work on a new server manufacturing facility in Houston and additional spending with its existing suppliers. What does this mean relative to what we we've already heard over the last several years from Apple. Mark Gurman, our star reporter here at Bloomberg, saying that Apple is going from investing $86 billion a year to $125 in the US, and from hiring 4,000 R&D employees a year to 5,000, based on its prior 5-year commitments compared to the new 4-year commitment announced this morning. The president responding to that new commitment, saying the following: Apple has just announced a record $500 billion investment in the United States. The reason, faith in what we are doing, without which they wouldn't be investing 10 cents. Thank you, Tim Cook, and thank you, Apple.
So this goes to the heart of the question: how much is this actually a massive ramping up of Apple's plans versus signaling to President Trump saying, look, we're doing our part. You can celebrate this as a win. Now you can not penalize us potentially for doing business outside the U.S. and having production in China.
This is a slight acceleration of prior investments, how Mark Gurman talks about it on Twitter, from their April 2021 announcement of how much they were going to move some jobs and investment into the United States. But for Donald Trump, he is going to sell this as a record brand new investment. It's not. There's a little bit of nuance and a caveat we need in this truth, which we're not exactly getting.
To extend the conversation, Henrietta Trace of Vader Partners joins us now for more. Henrietta, the objective of this administration has been pretty clear on the economic front coming into power. They were going to make life very easy and very simple if you invest in America, and difficult if you're trying to export into America. Apple's making an investment decision this morning to invest more on the margin, to hire more on the margin. To help that a little bit more, they talked about lowering the corporate tax rate. Henrietta, where are we on that front? And what's the timeline for the tax bill now?
Great segue. I didn't see that coming, but happy to talk taxes. The corporate tax rate reduction is something that scores really well from a dynamic perspective, meaning when the House Republican Conference released its budget, they are telling the American public that keeping taxes at their existing rates for individuals will boost the U.S. economy by $3 trillion. They're not going to get a score from any government official or JCT or CBO that suggests that that's remotely true. The real number is somewhere $379 billion, if I recall. But if you're able to cut the corporate rate or bring any tax preferences for businesses into the equation, you do generate more dynamic scoring. So it's expected that you'd hear jawboning about reducing the corporate rate. Every percentage point costs $150 billion. They're already $500 billion short of where they need to be. So my expectation is very low that we see a corporate rate cut going into the tax bill this year.
Well, if they want to get to the corporate rate cut, they got to start somewhere. If they want to lower it, will we see potentially this budget deal that Mike Johnson is going to be back in Congress this week? Will he put it on the floor, and will it pass?
Yeah, that's the question of the week for sure, Emery. The expectation is that tomorrow night, beginning somewhere after 6 p.m., he's going to bring the House budget as it stands right now to the floor. Now, this budget is going to need to go through the Rules Committee, but once it gets to the floor, you have members who have heard an earful from constituents all week long. And that is from, Texas to Pennsylvania. Members who are very concerned about the $880 billion in Medicaid cuts. When you have representatives from states like Minnesota, for example, 21% of their constituents are on Medicaid. So $880 billion worth of cuts from energy and commerce is going to hit them. There's massive cuts to Pell Grants, as well as SNAP and TANF. Members have serious heartburn in both the House and Senate on this legislation. And the public outcry from members is what you really want to watch. And there have been members who are very willing to go on the record, from Susan Collins in Maine to John Curtis in Utah, saying, hey, this bill is not ready for prime time yet.
Can they cut from the Commerce Committee without hitting Medicaid?
Not at $880 billion. There is not a way. So what you want to look at is the tiering of what is possible from Medicaid. My colleague Spencer Perlman is our healthcare expert, and he thinks the work requirements are the lowest hanging fruit. That's about $120 billion in revenue. You're still going to need more than that if you need to get $880 billion from E&C. So they're going to need to be looking elsewhere. The Senate Republicans are saying, hey, I've got a better solution. Increase the deficit by more. So we'll see if the House Republicans can address that.
Over the weekend, Henrietta, there were a number of reports about Republican representatives getting angry responses from constituents. And then I looked at the popularity of Donald Trump and some of his policies being at some of the highest levels of his administration, and certainly much higher than going back to his previous tenure. I'm just wondering, where's the truth here?
Yeah, cuts for thee, but not for me. I think that Donald Trump personally remains extraordinarily popular. People like the disruption that he's bringing to Washington. The culture wars are very much a part of his appeal. You saw it on display in Maine earlier this weekend, talking about transgender sports. So there is a incredible salesmanship that goes on in Trump's ability to connect with his voters that is entirely distinct from his actual legislative policies and the Republican platform, which across many provisions, including these cuts, is unpopular with constituents. So I think we've said this before on the program, but reducing the deficit is popular. Cutting spending is not. And that's something that they're going to have to equate with and take those tough votes. And that's why it's harder to be a House member than an executive.
Framing matters. Henrietta, thank you. Appreciate it. Henrietta Trace there, Aveda Partners, the latest on the tax bill. He's done exactly what many people voted for him to do. Wall Street spooked, and I use the word spooked loosely because we're still very close to all-time highs on the S&P. I'm talking about Friday directly. Wall Street was spooked on Friday because of the sequencing. Tariffs have come before taxes. And if we did this the other way around, like we did in the first term of President Trump, I think you'd have a different result.
Which is the reason why Bob Dole said he's doing exactly the opposite of what he did in his first term. I think it's right that you bring up Home Depot. We had Walmart and some of the expectations from them coming down, dampening because of tariffs. Do we get the same from other types of corporate executives? That could change the tone.
The housing data has been pretty awful.
Yeah.
That's for sure, including the numbers on Friday. Coming up on the programme, I saw him walk into the building out the corner of my eye just moments ago, already looking 10 years younger. Amos Hochstein, the former senior advisor to President Biden for energy and investment, joins us in just a moment. From New York City, this is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. Bloomberg brings you breaking news 24 hours a day, powered by 2,900 journalists and analysts in more than 150 offices across the globe. Bloomberg Television. Context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Equity futures bouncing back from Friday's losses. We're positive this morning by 0.5% on the S&P 500. Losses on Friday on the Russell, pretty dramatic, down by 2-3 percentage points. The Russell this morning up by 0.8%. With 2 hours until the cash open, let's get you some morning movers. Let's cross over to Yahara Hackers. Hey, Yahara.
Hi, John. We start with a big story here. Apple investing big here in the U.S. Shares are lower, though. So I asked Dan Ives earlier why this is happening, and he said that this knee-jerk reaction is on the premise that Apple will diversify away from China. But he says it's the wrong reaction because it's just a doubling down on the U.S., and it's a way for Apple to get on the good side of the Trump administration. We have seen shares recover a bit from their initial drop, so the market may be coming into that view as well. Next up, we have Nike shares. Those are up 2.2%, and that is after analysts over at Jefferies upgraded the stock to a buy. They say the new CEO, Elliott Hill, has the right playbook. Not only is he engaged with current and lapsed partners, retail partners, he also says that they also see that he's driving innovation, and they say that you saw that last week with their announcement of their Skims partnership. And last up, we have Domino's, the pizza chain, getting hit here in the pre-market, down about 4%. Same-store sales here in the U.S. missed estimates, and it just shows how difficult it is to entice those budget-conscious consumers that, of course, Domino's is targeting. John?
Yahara, thank you. That stock is down by 4%. More from Yahara a little bit later on this morning. Lululemon and Lewis Hamilton partnership coming up as well, apparently. That was teased over the weekend.
Lewis Hamilton, really? Are we going there? I will just say this. Increasingly, it needs to have the star power behind it in order to get.
John loves him now because he drives for Ferrari.
I know.
So everything is going to be Lewis Hamilton.
I'm not embarrassed or ashamed of that. Obviously, Ferrari first, and then whoever sits in the seat, you back them.
All right, so you're going to put on a Ferrari jacket? Is that what you're going to wear tomorrow? With
Possibly.
A skinny tie?
Like when the season
with Lululemon.
starts, yeah.
With Lululemon pants.
On our radar this morning, several government agencies telling their employees to ignore demands from Elon Musk's Doge team to justify their jobs or face dismissal. The Pentagon and Department of Justice citing potential legal pitfalls and agency autonomy.
Legal pitfalls as well as potentially national security issues. What if you work at the CIA or the FBI, which Kash Patel, according to the Wall Street Journal, he's the newly confirmed FBI director, also telling employees to please pause any response to Musk's note because this could create more problems than find solutions. I will say, though, my phone was blowing up all over the weekend. There's more than 2 million federal workers who received this email with the subject line, "What did you do last week?" And then on top of that, they felt like they were being trolled by the president, who put out a meme of SpongeBob SquarePants marking off, cried about Trump, cried about Elon. So some are saying, is this really being done with a lot of dignity?
So this is the reason why I'm putting aside the dignity issues and the questions, even among Republicans that are saying you can make cuts and it doesn't have to be done this way. There's a larger question of how is this going to trickle into the data and how many people are actually leaving the government. And that's the reason why a lot of people are looking at jobless claims on Thursday and trying to decipher some of the counties in Arlington and around the D.C. metro area.
I'll say something quite controversial. I find that the people who are really good at self-evals are often the ones who aren't good at doing the actual work. You know, they're like really good at managing up and not good at like doing the managing.
Deleting my self-evaluation
Just experience.
right
Anyway,
now.
let me turn to this story. I might get in trouble for that one. TD Cowen reporting that Microsoft has cancelled leases for a substantial amount of data center capacity in the United States, amounting to a couple of 100 megawatts. This coming as Alibaba pledges to spend $53 billion on AI infrastructure over the next 3 years.
So this is really important for a lot of investors. Peter Bukvar put this out and said this story out there that Microsoft is canceling AI data center leases gives me more reason to believe that a stock market regime change is upon us, where the AI trade no longer dominates, and that DeepSeek was a game changer. A real question about whether you invest in the infrastructure, and that's over or not. Microsoft, for its worth, came out and said, listen, we're still investing the $80 billion. We still have our plans. We still believe that there is going to be sufficient demand to meet this supply. That's going to be the real question.
I want to hear from NVIDIA on Wednesday. My question, they came out and said that that effort was export compliant. I'm not sure how they know if it is or not. I'm talking about DeepSeek, of course. I'd like someone to follow up on on that on Wednesday and actually get some real answers on that front.
Yeah, how much is this, some of the high-powered chips that really fueled this, how much do you see some move to a more efficient way of programming some of these algorithms?
Those numbers drop on Wednesday afternoon. Look out for that. Let's turn to this story. Ukrainian President Volodymyr Zelensky saying the United States dropped its demand for Kyiv to commit to paying $500 billion as part of negotiations on a minerals deal. Zelensky saying U.S. military support must be part of any deal.
They want to see that military support, that military security. We heard from Scott Bessent. They're talking about this administration, that this deal would provide economic security and basically tether Kyiv with Washington when it comes to investment in commodities and raw materials. This deal is still being worked out right now, and it seems like the administration and Volodymyr Zelensky, the president of Ukraine, are using the media to almost negotiate the terms. I think we will get a clearer picture at the end of the week because you have Keir Starmer coming at the end of the week and then, of course, Emmanuel Macron this morning with the president.
Let's build on the conversation. He's 10 years younger. Without a tie, Amos Hochstein, the former senior advisor for energy and investment. Amos, welcome to the program.
Thank you. It's great to be here.
Good to see you. You seem happy. We can get into that a little bit later. This came from Javier Blas just in the last week. I know you've read the piece. What Ukraine has is scorched earth. What it doesn't have is rare earth. Surprisingly, many people, not least US President Donald Trump, seem convinced the country has a rich mineral endowment. It's a folly. What's your view on all of this?
Well, first, I think Javier has done a lot of research into this. Rare earths, I've never seen any evidence of rare earths in Ukraine. There probably are critical minerals, which are different from rare earths in Ukraine, but not at a stage where they've been identified and there's been any exploration drilling, not in any of the commercial quantities that we are aware of. There may be, and there are, I'm sure there's some data there behind some of this that suggests there is. But to get from a greenfield, from a discovery to a production, can take many, many years. This is not expanding existing deposits. So I think this is a worthwhile conversation to have with Ukraine about how to develop their mineral resources. We should talk about how to redevelop their gas resources, how to develop their green power resources. Ukraine, I believe, can be a major supplier of power to Europe. Critical minerals, I think, is going to be, regardless of how this turns out, is going to be many years away.
When it comes to all these commodities, wasn't a discussion like this on the table when you were working in government under Biden?
This has been under discussion since I was working in government in the Obama administration. So this has been many, many years. We've always wanted to see Ukraine develop its resources because that will give them economic boost that will allow them to be more independent from Russia and to grow their economy. The corruption was the issue, right? But the resources were there. The issue is we shouldn't be taking the revenue from it. We should want them to have the revenue so that they can invest in the country, so that their Ukrainians across Europe that had to flee can come back and they can rebuild a country, a military, a security apparatus, and a future for their people.
You mentioned corruption, so I am reminded of an opinion piece you wrote in 2020 when you left the supervisory board of Naftogaz. So you've done a lot of work in Ukraine when it comes to this sector. Do you think the corruption has gotten better since then, tackling the corruption?
Not really. I think there's a lot of corruption. Predates Zelensky. It was a corrupt society before the Maidan revolution. The idea was, let's make it better. I think it did get better, and then some of those efforts stalled. There's been a tradition in government when there's a little bit of stress to go and use that moment to rob the kitty from state-owned enterprises. That's a problem that sort of ebbs and flows. I think it continues with the state control, and during the war, it's hard to criticize during a war when you're having your cities bombed regularly, how you don't do that. So there's a lot of temptation there. But I think it's a systemic issue that the international community should tackle.
For just ignoring some of the more heated rhetoric around the Ukraine-Russia war, because of the lack of accountability of where funding is going, do you think that there's validity in pushing back on just how much the U.S. and even European nations are contributing to the Ukrainians in this Ukraine-Russia war?
Look, you got to separate a couple of things. One is we need to support Ukraine because another country invaded. You can argue whether or not the words that Zelensky used before the invasion were smart or not. Was it good or bad? nothing gives you the right to invade another country because you don't like what the leader said. You just can't do that. So they invaded another country, and we should support it. And they invaded Georgia in 2008, and if we didn't intervene, they would control all of Georgia today and Ukraine. So you got to stop that. Then I think 100%, and we talked about this already in the Biden administration, there's a lot of concern about where's this money going and who's in control of it. And this came up in many conversations with Zelensky, with his top people, about our concerns. So what you should do is tighten the controls on the money and put the oversight in place so that you know where the money is going. But you can't do it while also saying, well, because of that, we're going to allow the Russians to take a whole bunch of territory and win the war. So it's a really tough balance, but, you know, government's hard.
When you left the government, where was the Ukrainian situation in terms of how much territory Russia had taken and the sense of the balance of power at a time where it seemed like Russia was making some inroads?
So Russia was making some inroads, but largely the conflict had been frozen for a long time, where Russia makes a little bit of inroads, then Ukraine makes some inroads somewhere else. You know, on a net-net basis, Russia was making more inroads than it was losing, but it wasn't massive amounts of territory, so it was largely frozen. But that was in order to get to a negotiation. I agree with the Trump administration that enough is enough, let's get to a negotiation. I think you have to force both sides to come to the table, and you got to force some tough choices by both sides. Need to make some tough choices. Freezing the war in place and saying, okay, we're done, let's call this a border, is really tough because hundreds of thousands of people have been killed to do what? Just to allow for the parts of the country to go away? And then what? Is there a disarmed Russia on the other side? I don't think so. So they invade again in 2 years, in 4 years. So you have to create a negotiation that has both sides at the table, that allows for some kind of resolution that both sides don't like, but that ends the war.
Some people have made the argument that the current president, President Trump, is attempting to shock the Europeans into action. Can you walk us through your experience with the European allies? How frustrating was that?
I think for us, for the United States, it's always a bit frustrating. I think we like to go a little bit faster, and we want to do things more aggressively when it comes to areas of conflict and negotiations. On the other hand, on the economic policy, we tend to go a little bit slower. On the environmental issues, we were, as a pro-green administration, were frustrated by how far sometimes the Europeans would go without thinking through the consequences of where they were going, and then they would suffer the consequences, which affects us, and they create high watermarks that we then have to deal with our constituencies of why aren't you doing what the Europeans? And it's a bad answer. We say, well, wait 2 to 5 years, you'll see why we're not doing what the Europeans are doing. So I think there's always been frustrations there. We tried to do trade policy with Europe in the Obama administration, the Biden administration, the Trump administration. Now, again, very frustrating, very difficult to do it. So it's built into the system. But at the end of the day, these are our allies. And we have to recognize that the argument with them is this is the argument inside the family versus the arguments with others, which is outside the family.
But don't you almost sometimes need to maybe shake them up? You were part of the Obama administration telling Germany not to go ahead with Nord Stream 2, yet they did it.
Yes, and if they didn't do it, large parts of why their declining economy is now would have been avoided. They bought into the argument of your heroin dealer. The first hit is free, and after that you pay a big price. And it's not only that. I went to Germany before the Ukraine war, 5 months before, and said, something's wrong, you're in trouble. And they insisted that they weren't, when the Russians were playing a game of filling their storage in the winter from their own storage instead of from Russia. I said, how is it possible your pipeline's empty, but your storage is filling?
What took the Europeans so long to see the intelligence that the Biden administration was seeing and that Jake Sullivan was openly telling the press from the podium?
We shared all the intelligence. I think sometimes they had the exact same intelligence we had on the invasion. We knew, we were saying the invasion's coming on this day, on this week, on this day, at this hour. They refused to see it. No, this is just an exercise. I think sometimes being the neighbor, you kind of can't see us being an ocean away. We see it with clear eyes. We've missed plenty of intelligence. I don't want to, you know, we had 9/11 that people were training inside the United States and we didn't see it. So I think they were just too close to the Russians and always making the excuses for him. And that was the problem Merkel and others, they were making the excuses, no, he doesn't mean it. And I think we have to learn a lot of lessons, and Europe has to learn more lessons. But I think they have learned a lesson. They don't want this war to end this way because they're worried that this war, it doesn't end here, and 5 years from now he invades another country.
I wanted to finish on this because we could talk to you all day. I mentioned this a couple of times and I was half joking, but semi-serious, of course, 10 years younger, without the tie. I've said this a few times. There are some really, really smart, intelligent people that work inside our administrations here in the United States. We spoke to one last week, Secretary Besson of the Treasury. I worry more and more as years pass by that those kind of people want to go into US government. I consider you part of that. Dalip Singh, another, Wally Adeyemo, really talented, intelligent individuals. You might disagree with them on their politics, but when it comes to policy, they've thought things through. Do you worry about that too?
I think it's getting harder and harder to come into government. I mean, obviously the hours are terrible, the stress is high, your family time is terrible, and I've seen so much damage to people's families just by making the choice to, especially if you're at the White House or at senior levels in the government. And the problem is, if you're not already wealthy, it's becoming even harder because the income is relatively lower, and I get it, it's higher than the average American salary, but it is lower relative to what the earning potential is for the people that are in those jobs. And the stress on it and the amount that it costs you to manage your life, the government doesn't pay for, and the scrutiny. I mean, I have protesters outside my house yelling that I'm accusing me of genocide, going after my daughter and putting her on Instagram, my 13-year-old. That comes with the job, and it's not like the Secret Service was there to help me or the cops. I mean, they're just standing there watching. So what you get, the blowback that you get, and to manage your life, is really, really difficult. The process for confirmation by the Senate is out of control, and for relatively low-level positions. So to come and be an assistant secretary in some random agency, you are now supposed to hire lawyers and accountants and to do a forensics auditing of your life, of your personal life, of your financial life. I mean, it's too much. And so I worry that outside of it being, you know, I made a lot of money, so I'm going to go into government and play with that for a little bit, and that happens in both parties, I worry that it gets harder and harder to get good people to come in.
I think a lot of people share that worry. Amos, it's good to see you.
Good to see you.
Hopefully we'll catch up again soon. Amos Hochstein there, the former senior advisor for energy and investment to President Biden. Let's get you an update on news elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. At least 3 of ByteDance's major investors have marked up the TikTok owner's valuation to over $400 billion. Sources say that SoftBank's Vision Fund revalued the firm in December, factoring in potential for its AI business. Fidelity Investments and T. Rowe Price also marked up ByteDance. It is a sharp rebound after the threat of a U.S. ban. Elsewhere in China tech, Alibaba plans to invest more than $53 billion on AI infrastructure. That includes data centers over the next 3 years. The investment will be used to support the company's AI ambitions. It also plays into Alibaba's goal of becoming a key partner to companies developing and applying AI. In sports, Liverpool is moving closer to another Premier League title after beating Man City 2-0. Mo Salah scored the team's first goal in the 14th minute and notched an assist on the second. Liverpool now holds an 11-point lead over second-place Arsenal for the top spot on the table after the Gunners lost to West Ham. And that's your brief, John.
That's a happy weekend for Lisa. Danny, thank you. Was that right?
It was.
A better week.
And Mohamed Al-Arian.
Yeah, Mohamed.
So excited.
So pumped for Salah. I know. Up next on the program, underpriced.
In my mind, the Fed is underpriced at the moment. We have about 2 cuts in the price for the next 18 months or so. In my mind, pricing really skews in favor of them doing more rather than less as this year progresses.
Earl Davis of BMO joins us next from New York City. You're watching Bloomberg TV.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Equities bouncing back positive by 0.5% on the S&P 500. In the bond market, bond yields on a 10-year, 444.87. Under surveillance this morning, underpriced.
In my mind, the Fed is underpriced at the moment. We have about 2 cuts in the price for the next 18 months or so. In my mind, pricing really skews in favor of them doing more rather than less as this year progresses. And so the 10-year, excuse me, the 10-year a little bit too high right now. I'd be shooting sub 4%, closer to 3.5%.
Well, here's the latest. 10-year bond yields declining for 6 consecutive weeks, the longest run since 2019. Earl Davis of BMO expecting more to come, writing, expect 10-year yields to grind lower. Lower 10-year yields will be supportive of risk assets. Earl joined us now for more. Earl, welcome to the program, sir. Peter Chair of Academy said this only makes sense if the economy is weakening. Does it only make sense if the economy is weakening?
No, it doesn't, and we actually see the economy strengthening, and I'll come back to that in a second. The reason why it doesn't make sense is you just think it's just simple laws of supply and demand. Yes, that demand for there, let's assume it's constant for U.S. Treasuries. The supply is controlled by the Treasury. So even if they need to raise more funds because of deficits, they could control where they issue. And with now the yield curve being not inverted as it was, it's actually cheaper or less expensive for the Fed to issue more T-bills in shorter maturity. We have a sense this is where Secretary Bessent, based on his recent speeches, is leaning towards, is the control, not the control, but maintaining longer-term yields at a lower level, and that will help growth.
So, Earl, you're saying that right now the story in the 10-year is a supply story, not anything to do with growth expectations. Is that correct?
That is correct. And actually, and the reason why that's correct is we see growth continuing to accelerate. There's a few reasons why we see that. One is the Fed, basically the only thing they're easing right now is stress test standards. And by easing the stress test standards, that's actually an easing of financial conditions, which helps to stimulate the market. More importantly, the Fed Senior Loan Survey, Officer Survey that came out for the first quarter of 2025 showed an easing of lending standards for the first time in 3 years. That's what will fund and support small and medium-sized businesses and continue to support growth underneath. So although our base case is for no hikes, no eases this year, we are leaning more and more towards the possibility of a hike or a higher possibility of a hike than an ease, given what I just spoken about.
So if you see a hike, how much does that increase the chance of a weakening in the economy? And I'm just putting this out there as people start to think about a stagflationary-like kind of environment. I mean, is that kind of what you foresee later on?
It will weaken the economy, but it'll still be at potential. So the reason why they would hike is twofold. The second one being more important, but let me talk about the economy. The economy is overheating, or the economy is running above potential. So they will hike to get it within the realm of potential. The reason why they target potential and will do it is because inflation in this environment could really pick up. When you have small and medium-sized businesses having increasing access to loans and leases from banks, they are the ones that drive the economy. Combine that with less individuals to hire because of the immigration policy, you could see inflation come through in two ways. And these are the things that we're looking at. We're looking at wage inflation, which is a bit slower in regards to the releases, but as importantly, service inflation. Because where immigrants typically, or undocumented immigrants typically work, is in the services industry. So with less immigration there, we may see that accelerate and continue to keep inflation higher. So the Fed will hike because of that.
Oh, appreciate the perspective. Thank you, sir. Oh, Davis there of BMO. Answer the question we've been asking for a while. Does it reflect slower growth or would it support growth? And he's in the latter camp by the sounds of it.
Yeah, that he believes it will support growth. He also believes that this economy is running above potential and that the Fed's going to have to hike rates again. Also, a controversial view at a time where a lot of people seem to be discounting the chance of that rate hike.
That's a very different perspective this morning. Coming up, Abby Yoda of JP Morgan, Jeff Meacham of Citi, Kathy Bosch-Jancic of Nationwide, Krishna Mamani of Lafayette College. That's the third hour of Bloomberg Surveillance. Up next.
What prompted you to want to get out of just doing surgery to be an administrator and a hospital leader?
Watching others who did it well. I had a dean who recruited me from Birmingham, Alabama to Minneapolis, Minnesota, which is a big jump to convince me to move my family. I realized over time that my training as a surgeon brought a set of credible things to the table. One, if surgeons have a measure of emotional intelligence, not much of our training reinforces that. It reinforces skill, not necessarily emotional intelligence. But if a surgeon has some self-awareness and emotional intelligence, what they bring to the table of leadership are three fundamental things. Number one, they do everything in teams. Their operations, their patients they see is all team focused. Number two, they value process, but they hold themselves very much accountable to execution. They understand that it's good to explore a patient, but what really matters is that you take the tumor out. And then number three, they make difficult decisions on incomplete information. Those things I realized that I could bring to the table as a leader if I had a sort of a passion for working with people and had some sense of self-awareness.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
What about artificial intelligence? Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
From an index standpoint, you may not see as much excitement this year.
Markets have been resilient so far and maybe more than resilient in the second half.
When you look under the hood, there's rotation happening and there's dispersion, and that's what's dampening volatility.
Ultimately, it'll be a good environment for stocks, but it's going to be a little bit more difficult.
Right now, it is about being broadly diversified.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The third hour of Bloomberg Surveillance starts right now, live from New York City this morning. Good morning to you all. 90 minutes away from the opening bell. Your scores look like this. Equity futures on the S&P 500, firmer by 0.5%, bouncing back from the biggest one-day loss on the S&P of the year so far. On the Nasdaq 100 up by 0.4, on the Russell up by 0.7. This week, full of economic data, including jobless claims on Thursday and the Fed's preferred read of inflation on Friday. Then the big earnings report on Wednesday, NVIDIA. But I think we all want another read on the U.S. consumer. Look out for Home Depot coming up tomorrow.
Especially since we do have these fears of inflation, at least among some cohorts that responded to the University of Michigan sentiment survey. How much is that impeding some of the outlook for consumer-facing companies? We saw that from Walmart. It's the 1-2 punch. Consumers need to hold in to keep the economy going, and there has to be the hope that some of the investment in AI is useful and not necessarily going to be overproducing or oversupplying rather than moving to the next phase of the AI adoption.
We've had 6 consecutive weeks of lower 10-year bond yields. This morning, just a little bit higher by 2 basis points. The yield on a 10-year maturity at about 4.45. The data on Friday, difficult to ignore, just not great. Consumer confidence was lower. Inflation expectations were higher. Existing home sales, not impressive. A bad PMI, the worst one we've seen in some 17 months. Put it all together, not a great story to tell.
Not a great story to tell, and it comes at a time when you do see consumers and some companies alluding to the fact that they are concerned about the uncertainty in Washington, D.C. when it comes to tariffs. There's a number of dates on the calendar that we're still waiting to know exactly what level of tariffs will be put in place, whether it's aluminum, the auto sector, Canada, Mexico. The only one so far to stick is an extra 10% on China. On top of that, one thing also interesting, the unemployment rate. That is something that half of these consumers are also concerned about, that that's going to go up by the end of the year.
It sounds like a muddle. It sounds uncertain. It sounds scary.
I sound bearish
You
today.
sound bearish. And then you look over at what's going on in Europe, and they're still struggling to get a coalition together over in Germany. They're going to take 2 months to do it, and there's a question about whether they can increase spending. And this is the reason that even with all of this uncertainty and bearishness coming from us, you have the likes of Morgan Stanley's Mike Wilson coming out and saying it's premature to conclude a rotation away from U.S. stocks is sustainable. And Mislav Mateka of J.P. Morgan saying something similar. So a real question here about, yes, all those things are true, but the U.S. still may be a brighter spot than some other areas.
We should point out that last week we had record highs on both sides of the Atlantic, both in the United States on the S&P 500 and in Germany on the DAX.
Because ultimately the economy is still working fairly well. And in Europe, it's another story. It's just that there's such little optimism that anything could get done, that a little bit of optimism could ignite that, especially with some of the funds that are coming from the United States.
If you are just joining us, welcome to the program. We do bounce back by 0.5% on the S&P. Coming up this hour, we'll catch up with Abby Yoda of JP Morgan. As equity markets bounce back, we'll speak to Jeff Meacham of Citi. As vaccine stocks rally on reports of a new coronavirus in China, you might want to give that a miss in about 12 minutes' time. Kathy Bostjancic of Nationwide looking ahead to PCE inflation data later this week. No one wants to talk about that story, do they, from Friday?
Well, not really. I mean, really, we really are going to speculate about another pandemic, which we have no visibility on, and yet people are worried about what else can happen, especially with bird flu and egg prices going up. And, how many people send me messages over the weekend? I delete them immediately, but, you got to pay attention.
Jeff's a smart guy. He joins us in 10 minutes' time. Turn the volume up, not down. I said down earlier.
Yeah, you did. did.
Honestly, I really just don't want to deal with this again. Okay, we begin this hour with stocks looking to bounce back from Friday's sell-off. Abby Yoder of JP Morgan writing, the momentum sell-off could be attributed to weaker retail sales and some weaker than anticipated earnings from some retailers, stoking concerns about the health of the US consumer. We think this is overdone. We maintain our year-end price target of 6,400. Abby joins us now for more. Abby, welcome to the program.
Good morning.
Good to see you. Lots of economic data to get through on Friday. What stood out for you? What was most concerning?
I mean, I think the confidence numbers are really what people were gravitating towards in terms of the headline number and the inflation expectations, the longer-term inflation expectations hitting a 30-year high. Again, I think, and you all have been talking about that this morning, really that if you dig into the details, there's some political leanings that are driving a lot of that. And also I thought it was interesting, this was the highest level of unsolicited feedback around uncertainty as it relates to the political economy or what's going on environment. So I think that's interesting for that survey in particular. And so that's driving a lot of things that are going on in markets. But I also think, look, we got some data that was a little bit less than, rosy that we've gotten over the past couple of months, but the picture on the consumer is still the same. The narrative's kind of still the same. It's uncertain, but it's still really strong. And I think what we've seen, again, is a momentum unwind and some dollars gravitating towards areas that people were really not loving over the past couple of years.
At the index level, we mentioned the S&P 500 hit a record only last week. Beneath the index, the market internal speaking to that growth slowdown that maybe the bond market's been playing off.
Yeah, I mean, you look at the top of the leaderboard year to date, it's staples, healthcare, utilities. It's this really risk-off move. And what you've seen actually, and speaking of that, like you've seen just this very stark rotation from cyclicals, out of cyclicals into defensives. But when I think about that, that's in the US in particular. But then you're also seeing money move to Europe and China, which you would argue is a little bit more cyclical and more risk on. So I'm not really sure what the market's trying to say in terms of where the dollars are flowing.
Do you think that what we're seeing in bond markets is supportive of an ongoing equity rally, or perhaps questioning it just simply because it is on the heels of slower growth fears?
I think it's going to ultimately be a positive for the market. I think the market is very quick to react and change narratives that we're in a Goldilocks scenario and then very quickly say, oh, no, this is recessionary. We saw that last summer very, very quickly. I think once we settle in and we see, we're not in an accelerating growth environment, we're in a moderating growth environment, but at a fine level, right? At trend, let's call it 1.5% to 2%, which is fine. And so once you digest that alongside lower rates, I think that's ultimately a positive for the equity market.
We were talking about the week ahead, and we're concerned about the consumer and some sort of reality check. You said that you think that that's overdone. There's also a question around NVIDIA and how much we see a real shift in the AI story away from some of the picks and hammers and shovels to the applications, the software, et cetera, and how much that could actually pressure the index level just based on how much NVIDIA has been a huge driver. What are you looking for to really understand that?
Well, I mean, look, we've heard from the hyperscalers, they reiterated and even increased their spend. What we want to know is where that like-for-like dollar is going, right? Was it one for one? Is it one for, is it going to the picks and shovels one for one, or is it going elsewhere where it's going to be spread out a little bit more? Are those dollars staying more internally in terms of R&D too? I think that's a good question. For us, I do think, look, the news out of China a couple of weeks ago coinciding with the inauguration was something that we were expecting, like the change in the narrative in terms of the AI theme. It just happened a lot quicker than we thought, right? And that's not necessarily a bad thing. These things happen. I think your point around, concentration, that's something that investors have been very concerned about for a long time, right? The past couple of years, let's call it. So I don't know that it would necessarily be a bad thing to see that broadening out in terms of performance. I think what it means is you maybe don't see the market move as swiftly in each direction, right? Like the sell-offs are more extreme, the recoveries are quicker. Maybe that's what the end-all be-all in terms of the index looks like.
You made a good point at the start that when you look at the consumer survey, a lot of it is heavily political. But there potentially could be an impact on tariffs when it comes to companies. How do you look at potentially earnings per share? How much could actually be hit depending on which tariffs we get?
So that's an exercise, right? Because we don't know what exactly is happening and what's written in stone and what's being, just talked about. And we won't know for at least a month, I think, is really the timeline. I think when we think about it, the worst case scenario really would be those 25% tariffs on Canada and Mexico, right? Like those are our real trading partners at the moment. Obviously, from a relationship standpoint, that would be burdensome as well. But if you take everything at face value and you have 25% tariffs across the board on those two trading partners, then you incorporate some kind of tariff, universal tariff in Europe, let's call it 10%, and then incremental in China. I mean, that's a major, major hit to earnings. Let's say we have $30 of earnings that are expected to increase from 2024 to 2025. I mean, you could theoretically see 2/3 of that wiped away from tariffs if you do see that.
If you do see that, then would you have to edit your year-end price target?
Well, yeah, but that's not our base case, right? So inherently, we're maintaining that 6,400 because that is not what we foresee coming to fruition. It's just a risk that's out there. And I think when you're thinking about not only consumers, but corporates, we've heard this over the past, during earnings season, which has been phenomenal, by the way, like 16% year-over-year growth for 4Q, highest level of growth since 2021. You're just not getting the enthusiasm around the outlook because it's uncertain, right? And what happened after the election was these animal spirits and this risk-on move, but then it's being outweighed now, I think, by the uncertainty as it relates to tariffs. But to the point, we're still only 2% from the highs.
Your regional preference is the United States over the rest of the world. Europe has outperformed so far. Double-digit returns in places like Germany, in France as well. What's behind that move for you? Do you think it's sustainable?
Well, so I think the way that we're viewing it, you've seen a move in the multiple from 13 to 15 times. Historically, on average, it's around 14 times. So we're above average in terms of what we're seeing in terms of the multiple. You haven't seen it move from a fundamental standpoint on the earnings side. You've seen earnings come in a little bit better than expected there. Nothing, needle moving. And it's really a matter of like China's a little bit better than expected. Europe's okay. US is really what's holding it up. So to be able to, see a sustained outperformance, we can't get any more multiple expansion in our view. We're going to have to see it come from earnings. So until then, we're still on the sidelines there.
Just to wrap it up, Lisa wants to know if you're worried about bats and whether that changes the story.
About bats?
Bats, coronavirus.
Yeah, coronavirus.
Oh, well, actually, when you were saying let's not talk about the coronavirus, I was like, aren't we still on bird flu? Like I am on egg prices.
Exactly, right? But isn't that what everyone sends you messages about? All of your friends? Is this going to be real? How many eggs did you hear about the person who was killed over the weekend, who was a dairy worker? My friend's just crazy.
Your
I'm just saying.
Conversations get dark. I didn't get those messages over the weekend at all.
Okay, well,
do not disturb over the weekend.
Abby, appreciate your time. It's good to see you. Thank you. We'll leave that there. Abby Yoder of JP Morgan and the thoughts of Bremo over the weekend. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Israeli Prime Minister Benjamin Netanyahu said the new Syrian regime must demilitarize southern Syria. Netanyahu said that he won't allow the new administration to push forces into territory south of Damascus. Israel advanced eastward into Syria, creating a buffer zone after the former government was overthrown by rebels. Apple has said it will add 20,000 new workers and produce AI servers in the U.S. The company plans to spend $500 billion domestically over the next 4 years. It will include work on new server manufacturing facilities in Houston and a supplier academy in Michigan. President Trump responding to the news, posting on Truth Social, thank you, Tim Cook and Apple. New York City's congestion pricing program raised $48.6 million in its first month. The program has reduced traffic by 10%, with 2.6 million fewer vehicles south of 60th Street. The MTA plans to sell bonds next year to finance $15 billion of infrastructure upgrades repaid with congestion pricing revenue, and has seen increased paid rideship on subways and commuter rail lines. And that's your brief, John.
Danny, thank you. Appreciate it. More from Danny in about 30 minutes. You two done arguing over that?
Well, Governor Hochul went to the White House and tried to make this case to President Trump that congestion pricing works. They need this money, to Lisa's point. I think Trump said he's not budging on this one.
I just am writing my self-evaluation. We'll not be so bearish. We'll not focus on bird flu.
Get your South eval. We back to that again. I got a message from management. You and I didn't do one.
You did. No, I didn't. I did not do one. Okay. But I will say we don't really need to do one. You can watch us every day at 6 to 9. So if Elon Musk was to send us those bullet points, it would just say tune in.
That's what you'd say.
Yeah.
To management.
Tune in.
Okay. Good. You had your eval. Up next on the programme, the Morning Calls plus Jeff Meacham of Citi as vaccine stocks rise on reports of a new coronavirus out of China. That conversation next. This is Bloomberg.
The Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people,
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
the transactions,
Really a record-breaking moment.
Crypto VC is back.
and the technology.
It's really the beginning of a global on-chain economy. And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
The opening bell is 1 hour and 14 minutes away. Equity still positive by 0.5% on the S&P, and the bond market bond yield just about unchanged. The 10-year 443.51. Let's get you some morning calls. First up, Jefferies upgrading Nike to buy. The analyst saying the new CEO has the right playbook. That stock is up by 2.3%. Your second call from Bank of America downgrading Rivian to underperform, saying its Volkswagen partnership is complicating earnings forecasts. That stock is down by about 3%. And finally, Morgan Stanley upgrading Alibaba to overweight, expecting cloud revenue to double in just 3 years. That stock a bit softer. It's rallied recently, but we're down this morning by a bit more than 3%. Let's turn to pharmaceuticals. Some vaccine makers rallying after researchers in Wuhan, China said they discovered a new coronavirus in bats, similar to COVID-19. The virus is yet to be detected in humans. Joining us now, Jeff Meacham of Citi. Jeff, welcome to the programme, sir. One of those occasions, and I said to you in a commercial break, where I'm really happy to see you, but really don't want to talk about this subject, but we have to. The news out just before the weekend, Jeff. From your perspective, how serious is this?
Thanks for having me. Yeah, and I'm with you. No one really wants to talk about, COVID going back to the 2020 sort of era. And I don't think we will. When you look at the seriousness of this, there is billions of folks that have been vaccinated, have been boosted. I think that protects against if there is sort of bat to human transition. There's a lot of folks that have sort of immune protected. I don't think we're going to have a round of boosters, for example. And just in case, there is Pfizer's Paxlovid, I think, which could address obviously some of those more severe symptoms. So don't fret yet. Is my is the comment.
Love that. I'm very excited to hear more of this sort of soothing rhetoric. I am curious just how much vaccine makers have the capacity to ramp up production and, frankly, innovate new vaccines with some of the new technologies that they're using. Should there be a new virus that does come out? In other words, are they sort of more capable than they were 5 years ago to really stave off a pandemic?
Yeah, for sure. I mean, if you look at, Pfizer and Moderna, the manufacturing investments they've made over COVID, obviously they've had to redeploy some of that as vaccine demands have gone down. But, whether that's a new variant or whether it's a meaningfully different look of COVID, the capacity, the R&D, the investments are there. And I would say in general, though, maybe a next-gen Paxlovid would be helpful, just having another oral drug available, which could address signs and symptoms. But that drug itself is, I think, pretty good, for getting rid of, some of the patients that are most at risk, immunocompromised, et cetera.
Jeff, on Friday, there were a lot of reasons for markets to sell off, and there was a risk-off mood. But some people said it was because they got a number of emails about bats in Wuhan, and that's always sort of traumatizing for people. How do you gauge whether something is a real threat or not, whether it actually is going to boost sales of some of these vaccine makers, but more importantly, cause real havoc?
We've looked back at what companies said, on fourth quarter and what they assume for 2025. In general, I think we've been in a market of stability for some of the vaccine makers for 2023, 2024. There haven't been a lot of new changes to demand, and obviously the supply can be there if a new variant, for example, comes out and has a massive sort of infection wave. But in general, though, I don't know if we're going to see another boon to vaccine makers. What I guess I would be worried about is if there is a new variant that was extremely virulent, much more so than this Omicron subvariant, and we just haven't seen that yet.
Lisa, I don't think people will comply in the same way they did 4 or 5 years ago. I don't think they'll be able to mandate it in the same way they did 4 or 5 years ago. I hope we don't even have to talk about this in the next couple of months, but you can really feel the mood based from the conversations you've had over the weekend and the conversations I had as well.
Yeah, I don't think I could mandate it with my family, let alone have some sort of broader mandate, because it was deeply traumatic for a whole generation of kids. And I point to kids in particular because the socialization was so important at that point. So at a certain point, you have to think the tools have to come from the medical community. And it raises the question of Steve Pagliuca when he was talking about the developments using machine learning to really innovate and speed up the process for vaccines.
Jeff, I know you don't cover Moderna, but Moderna's really struggled over the last couple of years, over the last 12 months particularly. Jeff, I think if you're a company and you're waiting for the next pandemic, some people might say you don't have much of a business, if that's the business. What's Pfizer been doing, a company that you do cover? What have they been doing? Because they're not waiting for the next pandemic. What kind of offering do they have right now away from this conversation?
Right. So, from a Moderna perspective, they've obviously moved on from, a primary focus of vaccines into things like oncology, infectious or rare diseases, which is I think a good application of the mRNA technology. I wouldn't say Pfizer has really taken the mRNA technology to the next level. Their partner, BioNTech, is mostly oncology, but Pfizer has done a number of things in cancer. The Seagen acquisition, I think, is super helpful when it comes to adding to their portfolio and their pipeline. So they're investing in other segments, but I don't think they're by no means doubling down right on vaccines.
Jeff, how do you take into account some of what we're hearing from the administration, given that there has been a crackdown on spending with Medicare and Medicaid, but also just with RFK Jr. in the office talking about vaccines and raising some questions? Has that affected any of the outlooks or the investment profiles of any of the pharmaceutical companies that you cover?
For sure. A lot of investors are looking to, Pfizer, to some degree, Merck, some of the earlier stager companies like a Moderna, with less, on a dollar basis, less robust pipelines. But I would say in general, though, it's unlikely that you're going to see a lot of big companies maybe double down on their vaccine, kind of portfolios or their pipelines in terms of new vaccines that are needed. Most investors, I think, are worried enough about the risk that they're looking at, more easily understood markets like GLP-1s or oncology or, say, other infectious diseases. I just don't get the impression that, we're hearing from leadership from a lot of biopharmas that vaccines are the way to go. And so there is a bit of a reactionary approach to some of the uncertainty from RFKJ, for example.
Well, when it comes to uncertainty, we also see the CDC's quote-unquote disease detectors. These are the individuals that go out, say there's an Ebola outbreak in Africa, and have to go find out more about it. How much of a data gap could there potentially be for some of these companies if they're not going to be getting that data from the U.S. government?
Yeah, it's a good point. I mean, I would say that the good thing is that you have a technology like mRNA, which can react very quickly to a lot of the viruses that we're talking about. Could be bird flu. Historically, it's been Zika, for example, rotavirus, norovirus. So the technology is there to react quickly to a new and emergent virus. And so I feel pretty comfortable in the safety profile of that technology. And so that's why, I sort of can rest somewhat easy knowing that, the speed of addressing a potential emergent variant could be pretty fast.
You've made us all feel a lot better, Jeff. Appreciate it. Jeff Meacham there of Citi. Jeff, thank you. That news dropped. Was it Thursday night, Friday morning?
Yeah.
Started to move stocks, the vaccine makers, the likes of Moderna. I just sat there shaking my head. My phone has started getting the messages, literally repeat.
Yeah.
On repeat. I'm not doing this. We're not doing this again.
Not going to comply, even if it does. I love it. You were saying, turn down the volume. It's going to be awful. It's going to be scary. And he comes down and he says, basically, is it really that big of a deal? We've got vaccines. We can handle it.
Even Jeff's reluctant to talk about it. Up next on the program, we'll talk about the economic data. Kathy Boshantik of Nationwide, Krishna Mamani of Lafayette College. That data on Friday, just how reliable is it? And will it be confirmed by economic data still to come? Still to come this week, we've got jobless claims on Thursday and core PCE on Friday. Equity futures on the S&P 500 with 60 minutes until the opening bell. Firmer here by 0.5%, bouncing back from Friday's losses. In the bond market, yields just about unchanged. The 10-year 4.43. From New York, this is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Equity futures positive here by 0.5%. The opening bell about 60 minutes away. Let's get you some morning movers. We can get those with Yahara Hackers. Morning, Yahara.
Hi, John. We start with Tesla. The stock has been feeling pressure lately, and this is Domino's, not Tesla, but we'll get to Tesla soon. Tesla's shares have been feeling pressure lately, and it's no different today. And of course, some of that has to do with investors feeling like, there it is, Tesla now up. And that is on this news that we just received, which is that Tesla's premium cars will be getting a refresh. Apparently, there was an interview with a company executive, Lars Morave, who said that refresh will be coming later this year. But it's all over the map now, John. Next up, we have Coinbase shares. Those are recovering here. It's been whiplash for the shares ever since that announcement that U.S. regulators are planning to dismiss a legal case against them, because just hours later, we got news that there was a massive hack where about $1.5 billion worth of tokens were stolen at another exchange called Bybit. So Coinbase shares fell on that news, but it appears the happy mood is back in the crypto sector. And next up, we have Freshpet shares. Those are getting a boost after analysts over at Jefferies upgraded the stock to a buy. They're up about 5% now. And not only are they seeing positive revenue trends because people keep spending on their pets, they're saying the stock is worth 50% from where it's trading now. John?
Yahara, thank you. Appreciate it. You know the game that TK used to play with me, foreign exchange roulette? Used to join the program from London. Bloomberg Surveillance here in New York. I'd get on there, A block, top of the program. He'd bring me in to talk about markets. Argentina, go. That was it. It was like foreign exchange roulette. Argentina, go. Switzerland, go. And I had no idea what was happening. And these graphics would just come up on the screen.
Exactly.
And I'd have to respond to like whatever was happening in Argentina.
He loves the Thai baht.
There, yeah.
I remember a week of that.
Hungary, the foreign. Yeah.
Yeah. Oh, yeah. Hungary was a big one. How about, why is the Swissy here?
Loved FX roulette. Me, not so much. Investors looking ahead to key data ahead this week with the core PCE inflation print due out on Friday. Michael McKee, our economics and policy correspondent, joins us now for more. Mike, lots of economic data. What tops the pile for you?
Well, it's going to be a Friday deal, Don, because we're going to be looking at PCE, the Personal Consumption Expenditures Index, and also personal consumption. And we'll see whether consumers continue to spend. The big news is that we're expecting a mild PCE inflation number on Friday, just 2.6% for the core on a year-over-year basis, suggesting that the Fed is still making progress. We get consumer confidence tomorrow after the Michigan numbers upset the markets on Friday. That will be interesting. Durable goods, our company's still investing, and jobless claims, we'll be watching for any sign that federal government workers have been laid off. Lots of Fed speak, as you can see that calendar go by. Not really going to matter a whole lot because the deadlines for Donald Trump's tariff announcements aren't until next week and the week after. So the Fed is basically still in the same position it has been. We just don't know what the president is going to do, so we just can't make any decisions on what we're going to do. And John, I'll finish up by noting that Argentina has an economic activity index coming out on tomorrow. So that's going to be the news of the day there in Argentina.
I'm pleased you're still on top of things, Mike, because I'm not in the same way. Michael McKee there, looking at that economic data a little bit later through the week. We'll be looking for jobless claims on Thursday. This coming from Starbucks this morning, cutting 1,100 corporate jobs worldwide. Seen a few of these headlines from various companies, haven't we, over the past few weeks?
Yeah, and a real question about whether this is just simply culling the fat kind of cuts, or whether it's something more significant. Starbucks said that they're going to notify employees who are losing their jobs by tomorrow, by February 25th, and they're limiting several hundred open and unfilled roles. This is a real question, though. Is this the time for people to make efficiency reductions, or is this in response to something more?
I gotta shake my head, though, when I see this headline drop. North America VPs at Starbucks need to be in the office at least 3 days a week. 2025, and they need to be in the office at least 3 days a week. Meanwhile, you're cutting a number of corporate jobs worldwide. It just feels like this is stale and outdated.
This is part of the Brian Nichols shakeup. Got to remember that as well at the same time. Is it a cyclical signal? I think it's Brian putting his stamp on a company over the past few weeks.
Speaking of Brian Nichols, is he remote? Isn't he working in a different place? I'm just saying. I mean, hasn't he
I think he has access to a Gulf Stream and goes back and forth.
I'm just saying, you know.
I think Brian has different access to travel than maybe others do at Starbucks.
Look, I think that you're right. Starbucks is specific, but we are seeing a number of job cuts being announced, particularly of big tech, and you do wonder how much this is going to be an increasing efficiency play.
Stock is down by about 0.2%. Jobless claims just around the corner. Kathy Bochantic of Nationwide Mutual Insurance expecting consumer confidence to reflect caution and optimism, and income and spending to advance at a slower pace. Kathy joins us now for more. Kathy, before we look forward, I want to look back just a little bit. UMich Consumer Sentiment Survey gets lots of attention. Does it deserve it?
Good morning, John. Well, it does in some sense. In fact, what I find most useful is the inflation expectations component, and particularly the 5 to 10-year portion. And then we know the Fed focuses on that, right? That's a longer inflation expectations component. The sentiment index, you know, if you break that down upon amid political leanings, it's really sways, right? When Republicans are in power, their optimism is very high, and Democrats are in the dumpster, and vice versa. So it is very sentiment-based, and maybe not based on the economic reality. Plus, as you know, right, consumers continued to spend even when sentiment was really low. So we need to look at the fundamentals, and the labor market is key.
It's getting harder and harder to understand what the fundamentals are as we get a lot of noise. And we're talking about consumer sentiment, how politically it's being driven. We talk about the jobs market and how politically driven that might be. Earlier this morning, we got news from Apple, 20,000 new U.S. jobs with a nod to Donald Trump. This morning, Starbucks job cuts. Which is it? Is it jobs being created in the U.S. or is it jobs being pared back? Which headlines should we pay more attention to?
Well, good question. I mean, one thing, there's always jobs created and lost, right? There's tremendous churn in the U.S. labor market. And what we see and usually focus on is the net payroll number, right? Or net household employment number. But this churn continues to go on and on. I mean, from all indications right now, the labor market is still very strong. There certainly can be headline announcements here or there. Jobless claims still remain incredibly low, continuing claims. I don't get a sense that we're seeing a big change. Now, of course, we have to be nimble, right? And because the economy can operate on the margin and changes can occur, but we're not really quite seeing that at this moment.
John, you were talking about Brian Nichols. I was a little distracted because he's got a corporate jet. Yes, he does. But his offer letter included a small remote office at his home in Newport Beach, and he was expected to be in the office 3 days a week, which is exactly what they're saying to other people, that they have to be back in the office.
Can the office be Newport Beach?
I don't know if they can join his small private small home
like
office.
The remote office, the official office.
I don't know if that is the official office, but I just know that that was sort of the distinguishing feature. Kathy, we're talking about the idea of coming back to the office, and we're seeing that with certainly the federal workforce being demanded to come back to the office. We're wondering whether this highlights how much companies are getting the upper hand with workers in a new way than, say, 3 years ago, when they couldn't have mandated return to work in the same kind of way. Do you view it as that?
Well, I think it comes down to probably, different companies making their own decisions for their workforce. I would say that there is perhaps more leverage for companies and maybe more of a need to bring people together. But I think it is very, it's idiosyncratic. And I think, businesses have to decide what model works, best for them. And I think, as you talked about Starbucks, that's a very different, company. And I wouldn't say it's cyclical at all. As you mentioned, it has its own struggles that are really separate from the overall economy, which up until this point has been booming, actually.
Kathy, we've been talking a lot about the effects of the federal workforce and what DOGE is doing. On average, last year, we saw the U.S. government add about 35,000 people, once a month, and we got the non-farm payroll numbers. Do you expect a hit on the federal workforce to impact the jobs report?
So we're watching it. We're acutely, aware of the announcements and the work that's being done. We're trying to keep a spreadsheet and a tally of that. Not easy. But also remember, in that breakdown of the government, half is state and local, and actually probably even more is just state and local than federal. So that's one thing to keep in mind. And with these announcements of federal, it's not clear how many people were going to retire anyhow. I mean, there's a normal churn in the government sector as well. So it may be all told that the negative hit to employment is slower to unfold and maybe ultimately less than, the 10% at least that they initially were talking about. So my sense is, and people are on deferred contracts. So my sense is we're going to see the hit at some point, but it will be kind of more of a drip than a big drop.
Kathy, appreciate it. Going into the economic data later this week. Kathy Borchankit there of Nationwide on the data we've seen so far as well. Bit of a scare on Friday. I think we need to take a step back, get some perspective. Equity still very close to all-time highs. Unemployment still around 4%. Jobless claims in the low 200,000s. But I respect why people are jittery. We've got a new source of risk, tariffs, policy uncertainty. That's something we didn't have over the past year. Cuts to Washington. In the long term might be a good thing. In the short term might provide some disruption to the economic data. Got to think about this, though. What's worse than an economic slowdown? It's an economic slowdown the Fed cannot respond to or is unwilling to respond to. And Neil Dutter's making that point at the moment over at RenMac. The Fed doesn't have your back right now. That's a quote from Neil over the past week or so. That's a change.
It's a change at a time where people are worried about inflation still. And this raises a question of, is inflation as a concern overblown, which is something that Neil Dutta has made the point of. You can't have an inflationary shock if you have the housing market flat on its back. Or is this a Fed that has its hands tied because we are in a more stagflationary-like environment? And those are two different scenarios, and that's one of the key debates right now.
Neil Dutta joining us tomorrow, so look out for that on Bloomberg Surveillance. Here's the take from Krishna Mamani of Lafayette College. He goes on to say, what we have is a potentially softening economy that is being hit over the head with 2x4s of policy uncertainty. Instead of being nurtured, it's not good. Krishna joins us now for more. So, Krishna, the question I've got to ask you, sir, is why are we still very close to all-time highs on the S&P 500?
Well, so the underlying economy continues to do well, as you just said. Economic growth is decent, employment is good, income growth is substantial, and the consumers continue to spend. So the challenge is really not right now. The challenge is, 6 months out. So if you are a corporate executive and you're trying to make an investment decision as opposed to a consumption decision for your groceries or whatever else that you do, and your investment period is 4 or 5 years, I mean, do you just jump in and do all the things that you were planning on doing, or then let's take a pause and see how all of this works out? And I think that's really the risk. The risk isn't the current state of the economy. The risk is we may be potentially slowing down. The Fed can't do anything, and on the policy front, we are getting hit every day, twice a day.
If the risk is people pause, Krishna, and maybe that's reflected in the labour market as well, reinforced by this low churn dynamic which has gripped the US labour market too, what is most at risk in the equity market?
Well, so in the equity market, what is most at risk is really things that are extraordinarily high valuations, rather than things where the near-term impact of a potential slight slowdown would be substantial. So it's really the tech sector that is very vulnerable, not because they're not making money, it's just that their valuations are too high.
You wrote in your notes, Krishna, that not having a view is still the best strategy. How do you not have a view as an investor that has to actively put money to work?
Well, so, as an investor, you have a long-term target, and then you move around that target. So if you have a view, then you can adjust that target on a tactical basis. So not having a view for somebody like us who are investing for 20 years, 30 years, doesn't mean that we get out of the equity market. It's just that we don't overweight equity markets or particular sectors of the equity market.
Do you have a view then on the equity bond mix? Because one of the fundamental questions right now is whether some of the structural changes that are occurring right now in Washington, D.C. are going to change the trajectory for U.S. debt markets going forward, whether it has to do with reducing the deficit or whether it has to do with things like the Mar-a-Lago Accord, which had all sorts of excitement over the weekend. How do you view that in terms of longer-term balance?
So I think the reducing the deficit is a very noble goal. However, when we are talking about large tax cuts at the same time, from a realistic standpoint, that doesn't really reduce deficit in any significant or meaningful way. So I think if the structure of the market is going to change, it is not going to change because we have somehow found a magical way of reducing our deficit from very high levels that we have today. And as far as Mar-a-Lago Accord is concerned, I kind of shake my head, as somebody said a little earlier. It's like, this is third world thinking as opposed to a first world thinking. If the U.S. goes down that path, I don't know what to say. There'll be hell to pay at some point, it seems to me.
Krishna, when it comes to this policy uncertainty, you say it needs to be nurtured right now. What would you want to see out of the administration from a market perspective?
So I think the administration has some really nice goals that, rebalancing trade, creating jobs in the U.S. All those would be very good objectives, and I think are going to help the U.S. economy in the long run. It's just the way they are coming and the way the volatility is. We do say that we do something one day, take it back. We say something that we are going to do, then we postpone it. I think that that's really the issue. That is, we don't know exactly how things are going to shake up, what the timing of all of those things is. It's really more about that than anything else.
Hey, Krishna, always appreciate and respect your views, sir. I want to finish up with this. What would you do right now in markets? What are you doing?
Well, so, we are keeping ourselves very close to our long-term targets. If I have any spare money that I would like to invest, I would invest in bonds far more than equities. That's not a message that the market is taking to heart right now, but the risk is more on the downside with respect to the economic growth picture, employment, than it is for it to re-accelerate.
Hey, Krishna. Thank you, sir. Krishna Mamali there of Lafayette College. Mentioned Neil Dutta of Renmark, who will be with us tomorrow, published this just moments ago. Let me share it with you. Much of what we see in the financial press, tariffs, uncertainty, is a red herring. Goes on to say, an ex-post rationalization for an economic slowdown that was already in motion. I would anticipate a decline in longer-term interest rates and a sell-off in equity prices as risk appetite wanes. For the economy, expect conditions to deteriorate in the jobs market.
This is a reason why some people don't think that a decline in the 10-year is a positive thing for equities. Just take what we just heard from you, that you read about, Neil Dutta, versus Earl Davis, who said the reason why 10-year Treasury yields were going down was because the Treasury Department wasn't issuing longer-term debt. It just highlights how you can give two people the same metrics in the market, the same information. They can come to diametrically opposed rationales for what's going on, and it really highlights the uncertainty of this moment.
Do you know who might have some sympathy with one dimension of what Neil Dutta had to say? A surprising source might be Kevin Hassett, National Economic Council Director, who a few Fridays ago after the payrolls report suggested that maybe this labour market wasn't as strong as some people thought it was coming into 2025.
This will get tested in 6 months when they can't necessarily attribute that to the previous administration. But you're right. How long can that kind of carry through before those pro-growth policies start to give tailwinds to a different narrative?
Looking forward to catching up with Neil tomorrow morning. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. The Trump administration sent emails to more than 2 million federal workers, ordering them to report on what they did last week or be forced to resign. The deadline to apply is just before midnight in Washington. Elon Musk said the directive came directly from President Trump. However, several agencies, including the FBI, NASA, and the Pentagon, have asked employees to hit the pause on acting on the directive. Ukrainian President Vladimir Zelensky says that he's willing to step down if it means peace and NATO membership for his country. Zelensky says it's clear he wouldn't be in power for decades and would happily make that trade if the offer was made. Elsewhere, Pope Francis remains in critical condition as he continues to battle severe pneumonia. The Vatican says that the 88-year-old pontiff is still receiving high-flow oxygen to help with his breathing. Some blood tests show an initial mild renal failure, which is currently under control. The Vatican says the Pope continues to be alert and well-oriented. And that's your brief, John.
Danny, thank you. He'll be in our prayers, of course. Up next on the programme, we'll set you up for the week ahead. You're watching Bloomberg TV.
Behind the bright lights and adrenaline of pro sports is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I love the fact that you have, we say the cojones. Can I say that in Bloomberg?
Maybe moxie.
Yeah, moxie. I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all-stars like Billie Jean King.
Well, what should I learn? What should I do? I said, learn the business.
Jay Williams.
You're an asset, but how do you become the principal?
Paul Rabel.
We're going to be the league of digital, and that's why you're going to invest.
Adina Friedman.
I definitely am competitive.
David Rubenstein.
People don't come up to me on the street and say, let's talk about this private equity deal you did recently. Nobody does that. They say, let's talk about the team.
And so many more.
You need a clap?
No, I never. Go.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Equities positive here by 0.5% on the S&P 500. Bond yields higher by just a basis point on a 10-year, 444.68. The opening about 38 minutes away. The week ahead looks like this. Tomorrow, earnings from Home Depot. Wednesday, the big one, NVIDIA. On Thursday, another round of jobless claims, GDP and durable goods. And on Friday, core PCE, the Fed's preferred inflation read. Look out for that. We're also watching a midnight deadline for federal workers. Elon Musk's Doge sending a mass email over the weekend demanding they defend their work. Tyler Kendall joined us now from DC for more. Tyler, what's next?
Well, John, there's still conflicting guidance out there after many agencies told employees not to respond. What that signals to us is that these agencies didn't get a heads up before this memo went out. Now, it's still unclear what sort of legal basis Elon Musk, in his capacity as a special advisor to President Trump, would have to terminate federal workers. But President Trump did make clear that he would like to see DOJ get more aggressive. When we are talking about what's next, these legal questions, we are expecting the largest union representing federal workers to contest any firings that could come if people do not respond to this email. And remember, this really could be widespread. Only about 20% of the federal workforce is in the nation's capital and the surrounding areas. And often we talk about President Trump trying to shake up Washington institutions, but of course, this could go much broader than that and across the country. John, you've been talking about consumer sentiment all morning. When we talk about the University of Michigan's gauge that was out on Friday, it showed more than 50% of respondents said that their long-term unemployment expectations had risen. That is one of the highest numbers that we've seen since April of 2020, when we were in the height of the pandemic.
So the president has a busy day today when it comes to the international space. Emmanuel Macron is already in the White House with him. They have a call at 8 o'clock. Well, they're on it right now. When it comes to other G7 leaders, what's on tap between these two leaders today?
Right, exactly, Emery. They'll have a bilateral meeting followed by a lunch and then a 2 p.m. Eastern press conference. We'll be waiting to see what sort of headlines, particularly when it comes to security guarantees from Europe, come out of that. But also, I'm closely watching to see if we get any indication about how tariff negotiations are going. Of course, we know that pending aluminum, steel, auto tariffs could really hit the European Union. But Anne-Marie, I would just point out some interesting timing. Late Friday night, President Trump opening the door to potentially implementing tariffs as a way to counteract digital services taxes. I bring that up because France was one of the first countries to implement a DST back in 2019. It's something that President Trump tried to get rid of during his first term in office. And of course, these hit some of the biggest U.S. tech companies like Meta and Alphabet. And considering the Apple news earlier this morning, it would appear that tech is at least somewhat on President Trump's mind.
Hey, Tyler, appreciate it. Thank you. Tyler Kendall down in Washington, D.C. Haven't talked about it much this morning at all, but also pushing Mexico to put their own tariffs on China to prevent the goods coming through the back door into the United States.
This is the real story, though, and actually this is the one that you got to pay attention to. There has been a longstanding gripe that has crossed administrations about Mexico being the back door for China products into the United States, and that is a real question. If you want to isolate the two economies, how do you do it without some of the allies participating?
It's a warning shot to anyone that wants to do nearshoring or friendshoring. You have to make sure that you are still isolating China when you're doing that, if you want your products welcomed in the United States.
It's a good start to the week. Equities bouncing back by 0.5%. Long week still to come. Coming up tomorrow, Sharon Bell of Goldman Sachs, Mike Wilson of Morgan Stanley publishing a little bit earlier. The debate turns to growth. The debate is turning to growth in a big way. Bond yields down for 6 consecutive weeks coming into this week, the longest weekly run since 2019. Tom Kennedy of JP Morgan will respond to that, and Neil Dutta of Renmark on why he is not constructive on this economy and hasn't been for a number of months. That conversation coming up tomorrow morning. Live from New York, thank you for choosing Bloomberg TV. This was Bloomberg Surveillance. This is Bloomberg TV.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
What legacy I would love to leave is to make sure that in my village I have infrastructure. So long when I'm gone, things are still working, then I have done my job. And if some people get inspired through my work and then try to engage themselves for their community and create something that is inspiring for everyone, I will be happy.
What's the best piece of advice you would give to someone young who wants to make a difference actually in this world? In architecture or with something else?
Wow, I'm not the right one to just do that.
I think you are.
Yeah, but with the pressure you have, and then you try to be the good one, the fancy guy, the intellectual one, I have no advice than to believe in yourself and really work hard. You know, when I started, No one would have imagined that I will be able to see my name connected with Aga Khan or Pritzker or sitting at Bloomberg to talk about sustainability, about future of sales. No, Marcel, 5 years ago, if you told me that, I will say no. I will never imagine. So I will encourage everyone to believe in what you're doing and not try to run after the newest of the newest. Just be consistent. Just work on things that matters for you. Really, at the long term, it pays.
In case you missed it, from Bloomberg's coverage at Davos.
Do you think there's one particular thing that you'd like Trump to change in terms of what some people see as the over-regulation of banking in America?
I don't believe, honestly, that we should have a huge amount of deregulation for larger banks. I think that's, you look back at COVID and any crisis, big banks now are strong, are able to step in and being part of resolving issues rather than being the one that creates issues. So I wouldn't really welcome a huge wave of deregulations. What I can see is that, of course, what happened in the US doesn't mean automatically that you will see in Europe or in Switzerland or in Asia deregulation. So the fact is that US banks may become even more competitive internationally through a more benign environment.
Nobody covers Davos like Bloomberg.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
All right, the biggest drop of the year on Friday, but we're bouncing back a little bit in terms of futures. 30 minutes to go until the start of trading. I'm Matt Miller.
I'm Shonali Bassick.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
And coming up, stocks attempt to come back after the S&P 500's worst session of the year on Friday. Investors shaking off tariff fatigue and bracing for NVIDIA's pivot earnings.
As we await NVIDIA on Wednesday, Apple announces plans to invest $500 billion in the U.S. over the next 4 years. Meanwhile, Microsoft has reportedly started canceling leases for its AI data centers, raising concerns about demand.
And Warren Buffett is still sitting on a huge pile of cash. His Berkshire Hathaway hoard grew to a record $334 billion in the fourth quarter as operating earnings surged 71%. All of that and more coming up. But let's take a look at where markets are trading after that wipeout that we saw on Friday. Like Matt said, of course, coming back a little bit, trying to claw out of that hole, but a long way to go when you consider that the S&P 500 fell by about 1.7% on Friday. We had weak sentiment data. There's concerns about what's going on when it comes to that other bat virus that's brewing. You take a look at the S&P 500 right now, though, higher by about 0.5%. Similar story if you take a look at the NASDAQ 100 with your big tech index, also higher by about 0.5%. The bond market is an interesting one. We are coming off of 6 straight weeks of falling yields, but we've been around these levels for a while, sort of glued to that range that we've been trading in. And right now, Matt Miller, the bond market pretty much unchanged on the 10-year.
Yeah, but I think it's fascinating that we're down 6 weeks in a row on the 10-year yield. We haven't seen a run like that since 2019. In terms of stocks, you know, we did hit an all-time high last week, but when you look at what that's been driven by, it's a little bit concerning. Here's a year-to-date look at the S&P 500 broken down by sectors. Consumer staples, the biggest winner. Healthcare, the second biggest winner. Utilities, the third biggest winner. These are incredibly defensive sectors, so to be driven higher by investors rotating into a defensive position is not really causing anyone to sort of buy new hats.
It's kind of a bummer, too. If you look at what's gaining in those consumer staples, it's some companies that have been doing very poorly the last couple of years. So valuation is everything in this market. Matt Miller, let's look at the values right now of some of the biggest stocks in the market. We're looking at NVIDIA up about 1.9% pre-market. We are looking at shares climbing ahead of the big day, earnings on Wednesday. The report will likely determine the direction of markets on Thursday, and investors, of course, are keeping a close eye on supply and demand demand for its Blackwell chips in particular. Microsoft now on the rise. This is interesting. They were fluctuating this morning. There's some analysis out there that Microsoft is canceling leases for its data centers in the United States, according to analysis by TD Cowen. The company reiterated its AI spending target of $80 billion for the year. However, Apple, though, down 0.5%. This comes after news that Apple will invest $500 billion over 4 years to expand its infrastructure in the United States. The company will add 20,000 employees in the process, and that's all as it grapples with threats from the Trump administration in terms of tariffs, particularly as it pertains to China, Matt.
Yeah, I mean, everyone's grappling with those kind of threats, and the Trump administration is really moving on China. We already have actual tariffs there under the International Emergency Economic Powers Act. Plus, we have Donald Trump, I guess, trying to convince Mexico to put its own tariffs on, and you have him asking CFIUS to cut China spending as well. So really a triumvirate of attacks on the China front.
Yeah, especially when it comes to tariffs. I mean, it feels like traders are trying to suss out what is signal, what is noise, what is a negotiation tactic, what is actually going to turn into policy. Let's talk about the stock market, though. I mean, it was really interesting to see these losses just accelerate into the close on Friday. And, you know, we've seen some delayed reactions to data. It felt like a little bit of a delayed reaction when you go back to the sentiment data that we got at the top of the 10 a.m. hour on Friday. Long-term inflation expectations, the 5 to 10-year outlook, 3.5%. That's the highest since 1995.
And what I think is fascinating is that even though inflation expectations are high, yields were driven lower. And this really shows you how worried people are starting to get about the economy. People are looking at that consumer, how much it could drive the market. Made you guys a chart of the Magnificent Seven, which is down on the year, versus the 10-year yield. And you could see the differential. Over the beginning of last year, it was quite large. Yields went down, the Mag 7 went up. And this is no longer true. And I think that is a fundamental truth that this market is going to have to now grapple with.
Well, I think it's, of course, sort of the same story, because you think about traders being reluctant to hold risk into the weekend. They're buying safety in bonds. So bonds taking on that haven role as we question big tech. Let's cover all the tech news with Bloomberg Intelligence senior analyst Mandeep Singh joining us now. And Mandeep, I want to start with Microsoft and a very curious note from TD Cowen saying that Microsoft has started to cancel some leases for U.S. data center capacity. We've been having some lingering questions about AI spend since DeepSeek sort of broke the internet a couple weeks ago. What do you make of this? What should we take into this heading into NVIDIA earnings?
Well, right now, I think all the mega cap companies, especially here in the U.S., are focused on building data center capacity in the U.S. We saw the Apple announcement. So what it shows is there is a pressure from the administration to really double down here in the U.S. So, I mean, look, all these companies are international. So as part of their CapEx plans, they have plans to add capacity outside the U.S. I think they will pare back in terms of, focusing here in the U.S. And then with the DeepSeek, as you mentioned, look, everyone is focused on how much you can scale up training. And there have been doubts created after the DeepSeek moment. So a company like Microsoft can say, okay, we want to focus more on inferencing. And that's where, wherever we can add data center for inferencing, that's what we'll prioritize for now. So I think those are the two drivers, if you ask me, when it comes to Microsoft's plans.
I think I'm also very interested in the Apple news and the initial market reaction around it. It's not the first time we saw companies try to rearrange their businesses around tariff threats, is it?
Yeah, look, I think with a company like Apple that generates over $100 billion in free cash flow, if their CapEx budget is $10 billion, whereas a Microsoft and a Google are spending above their free cash flow generation of $70 to $75 billion, it makes you wonder, why is Apple not spending? And in this case, I think administration wants all these large tech companies to spend here in the United States. I mean, Apple, with their free cash flow, is a no-brainer. So I think, and they can spend on two areas. One is the server side. The other is the chip manufacturing. I think they're going to prioritize the buildup of data centers right now, given all the emphasis on AI.
We'll see also how much they're actually rearranging.
Right.
It sounds more like just a rebranding of plans that they already had in place.
America first.
Mandeep, thanks so much for joining us. Mandeep Singh there from Bloomberg Intelligence. Want to broaden out the conversation right now with Jack Janasiewicz, portfolio manager and lead portfolio strategist at Natixis Investment Manager Solution. Jack, we see this Apple headline, right? They're going to invest $500 billion in the U.S. over the next 5 years, all thanks to Donald Trump. But the last time they came out with the 5-year plan, it was 430, and so it's only a 16% increase. They've hired 20,000 people over the last 5 years. Now they say they're going to hire 20,000 people over the next 5 years, all thanks to Donald Trump. But this is just business as usual with a different slant, right?
Yeah, 100% agree, and I think this is really just more of the same. You know, I think the read-through that the market's trying to get is that are we really starting to see a significant cutback here? And, you know, I'm sure when we hear the NVIDIA conference call on Wednesday, we'll get some confirmation of how that's shaping up. But I think the bigger picture here is simply a shift that should be playing itself out with AI, right? We're going to move away from these data centers and probably move more towards inferencing. And that's basically what Mandeep just walked through there. You're going to see the evolution of the AI trade, and it's going to continue to shift.
Let's talk a little bit about NVIDIA and how high the stakes are right now, if you want to say that, Jack, because we've been joking the past couple of quarters, it really feels like NVIDIA earnings have become a macro event. People are talking about it in the same importance as a Fed meeting, for example, an inflation report. How are you thinking about NVIDIA this time around and how much it matters for market sentiment at this juncture?
No, I still think it does matter, maybe not quite as much as it has been. We've seen a little bit of the steam coming out of the Mag 7 more recently, and I think the focus has been shifting a little bit more to geopolitical concerns in here. So, you know, when you start to think about the sentiment that we've been sort of going through with regard to either corporate sentiment or confidence, business sentiment, business confidence, that's sort of been wavering more recently. And so you start to get some weak economic numbers here, and not surprising, that's what we got on Friday. You get a sharp sell-off. So I think at the margin, these Mag 7 earnings will help. NVIDIA will help. But I think the focus is shifting a little bit more to these geopolitical headlines that continue to come out of D.C.
There certainly seems to be some jitters under the surface. Jack, I want to point back to some comments we heard last week from Steve Cohen over at Point 72, speaking at the FII conference. He was talking about a period where he believes the best gains have been had, and it wouldn't surprise him to see a correction. Do you agree with that?
You know, I think we're turning a little bit more cautious in here. And one of the themes that we talked about at the beginning of the year with our clients was, you know, one, maybe the outlook for growth was a little bit too sanguine. And two, maybe the market was a little bit too hawkish on the inflation outlook. You know, if you sort of fall back on that growth backdrop, you look at what's going on in the labor market, and we continue to see that cool. And the problem that we're running into there, you know, look at consumption. It's running above disposable income right now. That cannot persist. So we would certainly expect to see that slow on the back of slowing labor market backdrop. Consumption probably continues to slow, and that's just one of the pieces that we continue to point to. But at the end of the day here, we certainly expect the economy to slow, and I think that's the biggest risk in here. A slowing economy against sentiment that may be waffling, that probably sets up for a potential for a correction in here.
We're not going to see, a lot of people are telling us, Jack, any expansion in PEs, for example. So we have to see earnings increase to drive the stock market higher. And we're already expecting, we've already got a pretty high bar there, right? I mean, analysts have lowered it into the beginning of the year, but we're still looking at double-digit percentage gains for S&P 500 earnings this year. What are you looking at, and are we going to continue to see that come down?
You know, again, I'd like to say that we're simply slowing, but keep in mind we're slowing from a pretty elevated pace. And, you know, from our backdrop, we're looking at something closer to a 4% nominal GDP growth backdrop. And if you look at periods in history of 4% nominal GDP growth, that basically equates to a 9% earnings per share growth. So, you know, looking at a 9% earnings growth, maybe a little bit of a dividend increase there. It's not hard to get to a high single, low double-digit return on equities. But listen, we're going to get a correction along the way. We haven't had one in a while. It's going to feel bad. But the combination right now is, I think, setting up for that sort of correction. But if we do get that, certainly we'll look at it as a buying opportunity in here.
Yeah, and you've certainly heard a lot of folks sort of warning about that correction, including on this program. Jack, unfortunately, we have to leave it there. Always great to speak with you. That is Natixis lead portfolio strategist Jack Janasiewicz. Let's take a look at some of the other movers ahead of the opening bell, less than 20 minutes away. You can see Palantir. It's bad day. It's bad news narrative just gets worse. Down another 4% today after falling 15% last week. Those Pentagon budget concerns really weighing on this stock. Domino's is an interesting one as well. Its sales fell short with consumers pulling back on spending, but it was really a U.S. story because international sales actually pretty strong. And then you take a look at Bridge, currently higher in the pre-market. That's because Apollo is going to buy Bridge for $1.5 billion in its real estate expansion. Apollo shares also mildly higher right now, which is interesting because typically the acquirer falls. Not in this situation, though.
Yeah, that's pretty fascinating that Apollo's doing that kind of expansion at such a big premium, right? 35%
It's
gain
actually
for Bridge
the
shares.
market cap of $1.5 billion in value here. All stock transaction is actually more than 50% higher than where this company was trading on Friday after 3 straight years of decline. So,
all right, we will discuss that very soon. A lot to get to here. And coming up, Berkshire Hathaway's operating earnings surged 71% in the fourth quarter. We'll take a look at what's driving the move next. This is Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
we'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling.
Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
I think one of the dirty little secrets of credit is that the businesses generally don't pay you back, right? The markets pay you back, M&A pays you back. So what is the most important thing is to always make sure that the borrower is worth more than the loan. And as long as the borrower is worth more than the loan, then it might be a rocky ride, but you're going to get your money back. And this world where there's these disruptive companies that have, let's call it 100, 200, 300 million of ARR, are looking to not raise equity capital because of the fact that they raised it in 2021 or 2022, and no one really wants a down round. But there's a lot of capacity in the capital structure to have, let's call it a structured solution. We think that there's a lot of opportunity with those businesses.
Up-to-the-minute global financial news whenever and wherever it happens. I'm Jonathan Ferro.
And I'm Lisa Abramowitz in Davos, Switzerland, and this is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onim, only on Bloomberg.
Let's get now to high interest and look at what's making headlines around the world. Tesla is preparing to deploy a software update for its Chinese customers to bring self-driving capabilities, or at least so-called self-driving capabilities. A lot of argument as to whether that really is autonomous. To the market. Bloomberg sources say the update is planned for the coming days and will allow Tesla owners to use driver assist features on city streets. The car maker was facing challenges with full self-driving in China because both Beijing and Washington place limits on how Tesla trains its systems to handle local roads. So there you go, more than you ever wanted to know about Tesla's offerings in China. Starbucks is eliminating over 1,000 corporate jobs, or 7% of its workforce, in a bid to improve efficiency. The coffee chain is also closing hundreds of open and unfilled positions as part of its restructuring. The job cuts do not affect workers in cafes or in manufacturing and roasting operations. Workers who are losing their jobs will be notified by tomorrow. So we're giving you a little bit of a heads up here. JP Morgan is increasing its direct lending effort. The big bank is setting aside an extra $50 billion to capture a bigger chunk of the fast-growing market. The fresh commitment comes after the bank deployed over $10 billion in private credit deals since 2021. JP Morgan's expanded effort underscores how banks are staking their claim in the $1.6 trillion market that had previously been the domain of asset managers and credit shops. This sounds like something we would talk about in our Wall Street beat.
I know, we have more even to talk about there in the world of private capital, but certainly $50 billion is a lot of money.
Yeah.
JP Morgan tells Bloomberg that it's a comfortable number, a totally comfortable number for them to commit to. But we're going to switch gears. We're going to talk about the Oracle of Omaha this morning because Berkshire Hathaway reports a 71% boost in operating earnings. The jump is fueled by an increased insurance investment income. Buffett, though, also saw his cash hoard grow to a record $334 billion, and many are anticipating his next big deal. For more, we're joined by Matthew Palazzola, Bloomberg Intelligence property and casualty insurance analyst. Okay, 10 straight quarters in a row of their cash hoard expanding. At $334 billion, what does that say to you right now?
So first off, great problem to have, right, for Buffett. They just don't see a lot of opportunities. They don't see their stock as undervalued, so there has not been a lot of share repurchase. They've sold a lot of stock in 2024, so that was contributing to the cash going up, and they've been generating a lot of cash.
So it's like you say, this is a good problem to have. Champagne problems to an extreme degree. Should we stop holding our breaths, waiting for a deal here? Someone on Markets Live, Ben Ram, I believe, points out that at this point, Berkshire Hathaway has enough cash on hand to buy Coca-Cola outright.
I mean, I don't see anything that seems attractive to them in a space that they know, but you never know. Then they might find something that's boring and has a monopoly somewhere that they, really find interesting. But I've kind of given up on, a big deal coming around the corner.
What does Warren Buffett think about share buybacks? It's a hot political topic in this country right now. The Democrats, Elizabeth Warren, firmly against this kind of thing. But if you can't find anything else to do with your money, why not return it to shareholders? Yeah,
so he loves when companies that he owns buy back shares because that increases his proportional ownership of the company, right? But they never bought back a ton of Berkshire stock, and they only started a couple of years ago, and they've kind of slowed down. So I would think, in general, Buffett is vastly in favor of share buybacks, but he's very cautious when doing it with his own stock.
Well, speaking of his own stock, you do have Berkshire not only outperforming the S&P 500 since you look back to 2019, they haven't had a down year since 2015. That's 9 years in a row. How do people feel about Berkshire right now? You mentioned expertise. There's succession questions. Insurance has kind of just come back for them, and they've been missing out on a lot of the market gains when you look at their own investment portfolio, haven't they?
Yeah. Last year, they didn't really dramatically outperform the market. It's kind of been floating around. I think the operating businesses' earnings into next year have to go down, really, especially in the insurance business. In the fourth quarter in 2024, they saw a lot of kind of one-time or odd items in the insurance business that really pushed it ahead. So it's like going forward, the earnings outlook looks, not great. But their stock is still kind of hovering around all-time highs.
All right, Matt, it's always great to see you. Talking to you about something that's not a natural disaster,
Something
which
on
is
fire, blowing up.
nice change of pace. That is Bloomberg Intelligence's Matt Palazzola. And it's interesting to talk about Berkshire. I mean, we've all been waiting for a deal. We'll have to maybe take down our expectations there. But you do see a lot of folks trying to mimic the Berkshire Hathaway model. I mean, we talk to Elias Sabo over at Coty often, but also Bill Ackman. Yeah, exactly. But Bill Ackman trying to sort of be a mini Berkshire as well with this proposed takeover of Howard Hughes.
I think it's really fascinating because you have seen kind of an influx of baby Berkshires, if you will. You have KKR not being shy about kind of modeling the business plan, Apollo in a big way. With that kind of competition from private equity, there's a big argument out there that Berkshire has now gotten itself into potential bidding wars.
I don't know. With $334 billion of cash, that's quite a
I don't want to get in a bidding
hoard.
war against them.
No.
You know what's interesting? We used to always, Bloomberg News used to always put the age of the subject in the top of the story.
Are you
so
gonna
you'd see
tell
Warren
us?
Buffett, and then it would say he's 94. You know, which I thought was interesting and important information.
Yeah.
I noticed in the German election story yesterday, they didn't even say how old Friedrich Merz was.
All right. Well, you should write a letter to
They
the
need to
editor.
bring it back.
Listen,
Bring it back.
But back
He's
to
69,
Berkshire,
by the way.
real quick though, they tend to buy when things get really bad. So if we do see that correction, that's kind of when I would expect them.
That is the smartest. You think he read Benjamin Graham?
You know how many
The
people are
Intelligent
throwing
Investor?
that book out the door? But yeah, exactly.
All right, one of the biggest shareholders in Bank America is Berkshire Hathaway, and tomorrow on Bloomberg, David Rubenstein is going to sit down with the CEO of Bank America, Brian Moynihan. That starts at 8:30 a.m. New York time, an interview you don't want to miss. This is Bloomberg.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Welcome back to Open Interest, a check on futures as we count down to the opening bell. You can see a bid coming back into the market after that brutal session that we saw on Friday. The S&P 500 higher by about 0.4%. Similar story if you take a look at the NASDAQ 100. Small caps leading the way, at least for right now, with the Russell 2000 up about 0.6%. You do have the likes of Mike Wilson from Morgan Stanley saying that this dip that we're seeing, it's going to be bought. You have the U.S. with the highest quality index, the best earnings growth prospects. He doesn't expect it to last all too long, but who knows? We've been hearing a lot of correction talk over the past couple weeks, so we'll have to see. But coming up, less than 4 minutes until the opening bell, we'll discuss all of that with Rebecca Patterson next. This is Bloomberg.
In this facility, which is part of your $2 billion investment in the last 2 years, it's a massive amount.
Yes, because, we focused a lot on automation and upgrading our quality standards so that we can adhere to the US FDA and European standards, because some of our vaccines now are going even to the West, which is a fundamental shift in our strategy, from back in the day when my father started the business, where we were predominantly in India and the developing
India-centric, now you're more global.
Yes.
So you're about 8,000 strong in this facility? All Indian nationals?
Mostly Indian, yes. I would say 99% of talent that we've trained overseas and in India. We have our own internal skill building center where we train on site.
Serum started with just producing vaccine for tetanus, but it's producing a lot more vaccines now. What is the next big thing you think?
A global pandemic flu vaccine is something that we're working on, and I think the world will need that, not only for the annual flu cases, but God forbid there's a flu pandemic. I think we are very well poised to make 1.5, 2 billion doses and roll it out very quickly to protect the world. And we have, of course, the other vaccines, as we talked about, HPV and malaria, that we've just launched, and we're going to scale that up as well.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
We are moments away from the start of trading, looking to get a little bit of a rebound today from the big drop on Friday. This is Bloomberg Open Interest. I'm Matt Miller. Here you can see futures are higher. It's only 1/3% on S&P futures and NASDAQ futures. Russell 2000 futures up a little bit more. And we did have the biggest drop of the year so far on Friday after worries of the consumer and possibly a new COVID spooked investors. They're not as freaked out today. You hear the opening bell on the New York Stock Exchange. I've been waiting to see this guy. His name is Hunter Westbrook, which is like the preppiest name I think I've ever heard. He's the CEO of HTB. He didn't look extremely preppy. Down on the NASDAQ, Power Solutions International, P6. This stock is up 1,377% over the last 12 months. They are absolutely killing it. So a good day to ring the opening bell for them. In terms of the major averages, we are seeing a little bit of recovery. Don't forget, we did have an all-time high last week, so a little bit of profit taking, not to be unexpected. But Katie, what do we see right now in the live indexes?
Matt Miller, we had 2 all-time highs last week. Of course, it was hard to remember that specific fact when we were watching stocks really fall out of bed into the close on Friday. Like you said, a little bit of a bounce back here, people trying to maybe buy the dip a little bit, but we certainly have a long hole still to climb out of. The S&P 500 higher by about 0.4%. Big tech, similar story, up about 0.3% as we await NVIDIA earnings, which we'll get to in a second. The Russell 2000, this was your leader pre-market, but sort of giving up the lead right now, higher by about 0.2% on the Russell 2000. This was also your biggest loser on Friday, so we'll see how this leaderboard shuffles around. But let's talk about NVIDIA, climbing a little bit as Wall Street eagerly awaits earnings after the bell on Wednesday. Investors closely watching sales growth and supply for its Blackwell chips, as well as anything Jensen Huang has to say about DeepSeek, which, remember, triggered NVIDIA's biggest single-day loss back in January, but shares currently higher by about 2.5%, Shanali.
I'm also looking over here, Katie, at big tech and spending plans. Microsoft flat this morning, essentially. It is pulling back on its data center growth. The company is canceling leases, according to analysis from TD Cowen, and it's raising questions about the outlook for demand. Interesting to see NVIDIA shake off those worries, though. Apple now up. It has been fluctuating into the market open. Will be interesting to see where it ends the day. It is boosting its bet on the U.S. It's planning to spend $500 billion over 4 years to build out its data center and manufacturing presence in the States. Matt, I hear they're going to be building training facilities in Michigan as one part of that, too.
Training facilities. That's awesome. It's a golden age. We've entered a new golden age, Nolly. I think, well, we'll get into it, but Apple, if you look at really the 5-year plan, it's only increased spending 16%. and they're going to hire the same amount of people in the next 5 years they did in the last 5 years. But we're going to talk about this. Mark Gurman is actually going to join us later on in the show. He is a scoop machine when it comes to Apple, and he knows the lowdown. Take a look at the S&P 500. This is the last 3 days, so you can barely see today, but it comes off of the highest level that we've ever seen for the S&P 500, 6,144. So, yes, we had a drop on Friday. Wasn't one of the top 10 drops that we've seen in this bull market, I know from the Data Trek note this morning. But it was the worst we've seen year to date.
Yeah, which is saying something. Biggest downward move since December 18th, I believe. But remember that great story that we were talking about with Jess Menton a couple weeks ago, that so far in 2025, it's been Fridays and Mondays that have been the worst session. And it really speaks to this nervousness, I think, is in the market. Maybe you're not seeing it in the VIX, but traders just really don't want to hold risk into the weekend. They're happy to just dump on Friday and then maybe buy back as the week progresses.
And I think some of the problematic part of that, too, is the decoupling you're having from the interest rate story to the stock-specific story. There are different catalysts, and I think you can blame the quants a little bit here when it comes to the Friday moves.
I don't know if there's a decoupling, though. I think people are buying bonds 6 weeks straight because they're worried.
Yeah, well, that's the question.
But you're not seeing the indexes rise on the heels of that either. That's the bigger problem.
Well, I think everyone is worried, which is maybe why. But let's ask.
You don't buy the indexes if you're worried.
Yeah, right, exactly.
Yeah, yeah, yeah.
The reason the bonds are showing a bid is the same reason you're not seeing stocks rally off the heels of lower rates.
Yeah, so that story working together nicely. Let's unpack it all with former Bridgewater Chief Investment Strategist Rebecca Patterson joining us now. She also now serves as Senior Fellow at the Council on Foreign Relations. Rebecca, great to see you.
Good to see you
person.
all too. Thanks.
So let's actually start there. I mean, this relationship that you're seeing between the bond market and the stock market, it feels like for so long they weren't necessarily talking together, that bonds weren't acting as that haven asset class to equities. But you think about yields on the 10-year falling for 6 weeks straight. You think about this jitteriness that you're seeing at the equity index level. Are we seeing that diversification benefit come back to bonds?
I think we are seeing that diversification benefit come back to bonds. And one of the correlations, and I'm always careful about causation, but one of the correlations we've been seeing over the last few months is the economic surprise indicator. So U.S. economic data, is it better or worse than what's expected? It's been getting worse. So economists all got very giddy after Trump's election, thinking we're going to have deregulation, tax cuts, golden age, Matt.
Oh, yeah.
And what we're seeing instead is just more uncertainty, and that's starting to show up in data. So we've seen that surprise indicator actually go negative. And with that, you are seeing bonds quickly follow. So again, it's correlation. I want to be careful. That's not the only thing causing this, but I think that's what we're seeing. It's worries that we're going to have slower growth than what had been expected. And again, it's early days. We still could get tax cuts. We could still see benefits of deregulation.
Cuts, but you know what? It doesn't seem as likely that we're going to get all the tax cuts promised, that we're going to get a lift on the SALT cap, that we're going to get no tax on tips, no tax on auto loan interest. I mean, we are getting tariffs. The China tariffs have already come through, steel and aluminum kicking in.
We're getting a lot of tariff threats.
Well, China tariffs are on since February 4th. They have been enacted. Right? And you've got the sort of costs and chaos, as Jim Farley puts it. So, and we're getting deportation. So we're getting all those inflationary things as they, axe federal government jobs and spending. If they don't come through with the tax cuts now, that's a real problem for Wall Street, isn't it?
And it probably is part of why President Trump is pushing so hard to have one beautiful bill sooner rather than later to get that positive news into the market, to get that win, because it would be good for the economy, good for his party. But I don't know how quickly, reasonably, they can do that. We're seeing all the difficulties they're having within Congress right now, trying to move ahead on, is it one bill, is it two bills, how quickly does it happen? But to your point, what we're seeing right now is kind of the worst case scenario. We're getting uncertainty about policy coming through in surveys, and that is, and earnings guidance from Walmart and others, starting to weigh on growth expectations while inflation expectations are inching higher. And we saw that in University of Michigan last week, long-term expectations up to 3.5%. So if we get bond yields lower, that's what Scott Bessent, our Treasury Secretary, wants, but he's getting it because growth worries are increasing. That is not what anyone in the White House wants right now. You want lower yields because of lower oil costs, because of structural reform that increases supply side of the economy. And that remains to be seen.
Yeah, he might get what he wants, but for the wrong reasons. As much as I could stick on just that topic all day long, I want to switch gears a little bit, given that NVIDIA results are on Wednesday. I want to pull up the components of the Magnificent Seven, an index that has been down on the year, not a true index, but the Bloomberg index of it as well. Meta, you can see, is really the only significant gainer in that group. NVIDIA is up, but nowhere near what you saw a year ago. Tesla is a huge drag. When you think about how much this set of stocks has meant for broader market recovery, what does it mean that they're performing that poorly?
Well, I mean, we saw huge gains in these stocks in recent years. I mean, extraordinary gains. We know that these stocks have very strong free cash flow. We know that they still have strong earnings growth, especially for their size. The challenge is that everyone owns them. I'm speaking figuratively, but it feels like everyone owns them, and they have high valuations. Nothing like the 1999 valuations that we saw in that bubble, but still higher than the rest of the market. So they're vulnerable. So if you have disappointments, you have news like Microsoft's or news like DeepSeek, it's very easy for these stocks to see some profit taking. I think longer term, it's still a place I want to be, more neutral than overweight. And honestly, if the U.S. economy slows and we have, okay, what companies are going to have structural supports in a slowing growth environment? Tech is one of the answers. So I'm not giving up on tech yet, but I do think the fall in tech that we've seen recently is part of the reason you're seeing investors looking around the world. Is there somewhere else I can hide?
Right.
And that might be one of the factors helping places like Germany year to date.
And Rebecca, I think that's interesting and important that people are looking elsewhere, because you think about the NASDAQ 100 falling 2% on Friday. You take a look at the gains that we're seeing right now. Now we're just 1/10% higher on the NASDAQ 100. If we were in 2020, 2021, people would take a look at what happened Friday and say, stocks are on sale, let me barrel in here. But it feels like that buy the dip impulse is maybe fading a little bit.
I think we're now in a show me environment. Show me on earnings, show me on projections, forward looking, right? NVIDIA will be really important for what does Wang see going forward. If that picture is bright relative to expectations, you're going to see all of the Magnificent Seven benefit. But if there's a note of caution, whether it's the policy environment, DeepSeek, anything else, these stocks could still take a bit of a hit in the near term. Again, though, if we're in a slowing growth environment, not a recession, but just a moderation in growth here in the U.S., large caps tend to do relatively better than small caps, and stocks that have strong free cash flow tend to benefit, relatively speaking, and that means that you probably want to hold on to some of that tech for those reasons. Not add necessarily, not buy the dip,
right,
but not run for the hills either.
I have to say, God help us if Jensen Huang is cautious on Wednesday.
Yeah.
If he's not showing up in that leather snakeskin jacket and sounds a little bit worried, it'd be really interesting to see the trade.
Well, and we've got a lot coming up that's going to keep people nervous regardless of what he says on Wednesday. Between the possible government shutdown on March 14th, the tariffs on steel and aluminum that could come into effect on the 12th, you know, the next few weeks have some pretty major policy catalysts that could keep people a bit jittery about where we're going. And it gets back to the whole weekend, the bad performance on Fridays. You now have an administration that's going on X, Twitter, whatever you want to call it, 24/7.
Midday Friday in particular.
And so you have to be managing your risk, knowing that you could have a shock you have to respond to Monday morning.
All right, Rebecca, it's fascinating stuff, and kind of a bummer, really. Thank God we didn't get to the new bat virus. Rebecca Patterson there from the CFR, former Bridgewater chief investment strategist. We are looking forward, obviously, to those NVIDIA earnings on Wednesday, and tune into Bloomberg for that. We'll be laser focused on what goes on with tech when Jensen Huang dons the snakeskin, the faux snakeskin jacket. Coming up, Apple plans a $500 billion investment in the U.S., but had it already planned that, and it's just telling the president now for a carve-out on tariffs? Microsoft, on the other hand, is pulling back on data center leases ahead of those NVIDIA earnings. We're going to talk tech every day through Wednesday and beyond. This is Bloomberg.
number of people, I think, from Homeland Security and or the CIA or NSA have gone to Capitol Hill and said that TikTok is a danger to our national security. But the public hasn't been given that much detailed information about what the threat is. How much of a threat to our national security is TikTok?
The People's Republic of China acts adversely to the interests of the United States in different ways. One of those ways is through the dissemination of disinformation, the intentional communication of false statements, and TikTok is an extraordinary avenue through which to disseminate disinformation to millions and millions of people.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Bringing you up to the minute economic news whenever and wherever it happens. I'm Jennifer Zabasanja in Luanda, Angola, and this is Bloomberg.
Bloomberg brings you breaking news 24 hours a day. Powered by 2,900 journalists and analysts in more than 150 offices across the globe. Bloomberg Television. Context changes everything.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
All right, it's time now for our top calls. Some of the analyst action in focus this morning. And first up, Jefferies upgrading Nike to a buy, saying that the sportswear company is positioned for a strong recovery over the next 2 years, and also that the CEO has the right playbook. Shares higher by about 5.5%. Next up, Bank of America downgrading Rivian to a sell. The firm citing a softer outlook for the EV maker this year and notes that risks are piling up. And finally, we have Alibaba getting raised to a buy over at Morgan Stanley. You can see the shares are sliding, though, down more than 8% after it said that it expects to spend $53 billion, Matt Miller, over the next 3 years on cloud tech and on AI infrastructure.
Wow, that's only a tenth of what Apple wants to spend over the next 5 years. Big tech firms are adding, and it looks like maybe also pulling back on AI plans. So there's up arrows and down arrows. Apple saying it's going to spend $500 billion in the U.S. over the next 4 years to build out its domestic infrastructure. That's U.S. only. Meanwhile, Alibaba is going to put $53 billion toward its own AI agenda. But TD Cowen says Microsoft is scaling back on data center leases. Specifically, TD Cowen says Microsoft has canceled leases for a couple of 100 megawatts of data center capacity. Bloomberg Technology co-host Caroline Hyde joins us now. If this is true, it's a pretty concerning report, and they're saying it's all because OpenAI, in which Microsoft obviously owns a very substantial chunk, is going with others like Oracle to build out its compute.
Looking at the Stargate deal in particular, Bloomberg Intelligence has already weighed in and saying regarding this chatter, they just think this is a reallocation rather than any change strategically. Microsoft has come back and said, we remain committed to spending $80 billion. So whether you believe they're going to be reallocating it in terms of building their own or whether it's going to be more leases, are they going to be doing it internationally? Are they going to be doing it more in the United States?
But they didn't say they have not canceled leases for a couple hundred megawatts of additional compute.
But what many analysts are saying is this is ultimately just the way in which you do business. A lot of these leases
So they may have
ultimately,
canceled those leases.
they might have reorientated, changed up, whether these are long-term plans, whether or not you're indeed re-signing them in different places, whether or not it's sort of hadn't ever been a signed on the deal lease, but is something that they had agreed to in statement. I mean, Satya Nadella had talked about leasing additional capacity in 27, 28. BI saying, look, this is just about a reorientation of renting versus building. They think it's a good long-term sign for the company's capital spending direction.
I mean, isn't it just crazy to call it a lease if the deal isn't signed? I just think back to a conversation.
Well, who knows if that's the case? I mean, that's speculation,
well,
right?
Here,
We're speculating on...
No, I'm not. I'll give you an example. After the DeepSeek moment, I talked to John Gray about this. What happens to those leases if you're worried about CapEx spend? Any big company will tell you that these could be 10, 15, 20-year leases. They cannot possibly be that easy to get out of, right, Caroline?
I think it's ultimately what Meta used to do as well. It's sometimes that you have a measure of understanding that you're going to be doing a lease, but it hasn't actually been something that you've had to purposely agree to actually taking the money out. So I think this is something you see big tech companies do a lot of in terms of reorientating whether they agree to sign up to certain data centers or indeed not. And for me, the key takeaway is the company is still spending $80 billion.
Right.
How they're spending it, where they're spending it is what you want to be discerning. But what the real letter of the law is going to come in is when we see NVIDIA's numbers in the week. And ultimately, are people pulling back from AI investment? Many feel that NVIDIA is still going to be on track for 70% increase in revenue, a 63% terms in earnings per share. And since DeepSeek, they have still said nothing has changed in terms of the old overwhelming demand for AI compute. So I think now that's where we're going to get a little bit more of the tea leaves. We'll wait for a clearer statement coming from Microsoft, but I think ultimately they're trying to say this is the way we do business. Jordan Klein over at Mizuho saying this just seems like business as normal when it comes to Microsoft and what TD Cowen is currently trying to read into the chopping and changing of leases.
Right, and we'll stress again, of course, this is according to a TD Cowen report, so we'll wait.
The shares are down though, so I guess that's something to like know.
They are. No, it's certainly making a dent, and I think that just speaks to all of the lingering existential questions about AI spend right now. Caroline, before we let you go, I do want to ask about Apple, because Mark Gurman out with a really interesting story today that Apple said that it will hire 20,000 workers, also produce more AI servers in the U.S. I'll ask the question that Matt Miller has been asking all morning. Had they already planned to do this?
What's the devil in the detail is it looks like it's about 1,000 extra hires per year, and it's about $39 billion extra spending per year. That's not a massive ramp up, but it is a kind of ticking higher. And once again, Tim Cook is sort of makes an art of how you disclose these sorts of things. Remember, he did it back in 2018 when suddenly, oh, look at what we're doing in terms of our investment on making Mac Pros here in the US. Well, they'd already been making Mac Pros in the US since 2013. It's the way in which you dress it. So yes, they are doubling down on Houston. They're going to be making servers there. But remember, the chips that go in the servers are still being made in Taiwan. They're going to be making other chips here with TSMC, of course, in Arizona.
Certainly it does matter. To the cities, I'm looking at Detroit for you, Matt Miller, home of the audio industry. See if that will be a bigger home for Apple moving forward. Bloomberg's Caroline Hyde, we thank you so very much. Coming up, more on real estate. Apollo is continuing its expansion with a $1.5 billion all-stock deal of Bridge. We're going to take a look at the latest acquisition in Wall Street Beat. This is Bloomberg.
Your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal?
Are markets too optimistic?
How do you worry about the things that are outside your control?
How does the current fighting completely stop?
I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
And it's time now for the Wall Street Beat. Today, we're looking at Apollo's deal to buy Bridge Investment Group for about $1.5 billion in an all-stock deal. For more, we're joined by Bloomberg's Neil Callanan. You are seeing Apollo effectively double its real estate business. What's interesting to me is not just the spate of acquisitions Apollo has been going on to grow, but the areas. It zags right when the others zig left. You think about real estate, so many are entering data centers. Apollo is going into the business of homes.
Yeah, absolutely. This is an interesting one because, you know, the feeling for the last 2-3 years was that real estate was a bad place to be, but definitely there's been a mood shift. There's a feeling that there's going to be a great opportunity this year, particularly around multifamily that needs repositioning, i.e. people who had paid too much a few years ago. Now there's an opportunity to restructure that debt through a new credit provider. So that's one big area of opportunity. Another one then is around this 24% of all office loans in the US mature this year. In total, there's $1 trillion of commercial real estate loans maturing this year. And the Bridge is big on transitional positioning. So there's going to be a lot of money to be made converting offices into either more modern offices or things like homes or data centers potentially, depending on where they are.
Well, Neil, tell us a little bit more about Bridge Investments, because this deal values shares at about $11.50 per share. They closed below $8 a share on Friday, so a big premium there. Why does Bridge Investments specifically fit into Apollo's ambitions here?
Yeah, Bridge has about $50 billion of assets under management, so quite sizable for a commercial real estate provider. And they are in areas where Apollo isn't huge. So they're quite good at giving loans lower down the market. Apollo has come in and largely done big deals, sometimes as much as $10 billion loans. These Bridge is much smaller and does smaller loans around the country. So it gives Apollo that regional focus. And if you want to launch funds, particularly through the wealth channel, you've got to get a diversity of loans. So for smaller funds, mainly aimed at retail investors, these kind of loans are more suitable for that. So it's another way for Apollo to tap the wealth channel. It's also a good source of loans for Athene, Apollo's insurer, which has kind of a relentless appetite for credit investments.
All right, Neil, thanks very much. Neil Callanan talking to us about the Apollo deal for Bridges. Meanwhile, we have seen the S&P 500 turn to losses, so continuing the fall that we saw on Friday.
Those dip buyers, a distant thought right now, really erasing those pre-market gains, which were pretty hefty.
Coming up in the next hour, Stephen Yalof joins us of Tanger Outlets on the state of the U.S. consumer, a big part of the sell-off on Friday.
Offers before to take over Greyhound, but then in the middle of the pandemic, 2.5 years ago, we had this fantastic opportunity to buy the brand and the network. When we took on Greyhound, onto the Flix tech platform for network management, revenue management, we saw the highest unit economics in more than 100 years of Greyhound history.
My vision is to transform long-distance bus travel in the United States and make it one of the top considerations for anyone planning a long-haul journey.
CEO Kai Boyson imagines even more potential if state and local governments recognize the need to support long-distance bus travel with integrated infrastructure.
We need to think about the infrastructure in the United States holistically and think about the transportation system as one integrated system. And intercity bus needs to be an integral part of that system. One should be able to connect from one mode of transport to another seamlessly, easily. We have great success models in the United States. For example, Los Angeles Union Station, Boston South Station, or New York Port Authority Bus Terminal, or Washington, D.C. Union Stations.
Kai and the team, they are doing a fantastic job. They have really improved the product, they have improved technology, they have really made the production more efficient, that at the moment it's also a profitably growing business.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
CBS News on the Hour, sponsored by Progressive Insurance.
I'm Deborah Rodriguez. Breaking news as the clock ticks toward Elon Musk's midnight deadline for all government employees to list 5 tasks they performed at work last week or face the possibility of dismissal. The Associated Press says attorneys for federal workers have filed an updated lawsuit, courting California, calling the Doge chief's threat, quote, one of the most massive employment frauds in U.S. history. Correspondent Natalie Brand.
President Trump's own newly confirmed FBI director, Kash Patel, who essentially told his employees to not respond, as well as the State Department and the Department of Defense, all saying that they have their own internal procedures for review.
Apple will be hiring in Houston. CBS's Christopher Cruz.
The company is planning to spend $500 billion to, among other things, build a factory in Houston that will make AI servers that used to be manufactured overseas. The plant will open next year. Apple also said it will hire 20,000 people in the U.S. over the next 4 years.
88-year-old Pope Francis is still in critical condition at a hospital in Rome where he's being treated for double pneumonia and early kidney failure. The Vatican says he did get out of bed today and eat breakfast. CBS News Vatican consultant Father Anthony Figueiredo.
Quite recently as well, he indicated that should he die, he hopes it will be quickly rather than a long period of suffering.
The FBI is looking for more alleged victims of a Las Vegas woman accused of drugging and killing 3 men in a romance scam. She's now under arrest in Mexico. CBS's Andres Gutierrez.
People born after 1950.
Here is Andre Gutierrez.
In an unsealed indictment, the Justice Department charged 43-year-old Aurora Phelps with scamming 4 older men. Between 2021 and 2022, Phelps allegedly used aliases like Sissy and Laura on dating sites like Tinder and OkCupid to lure her victims. After meeting them in person, feds say she would hit their bank accounts and go on shopping sprees.
Health officials report almost 100 measles cases in an outbreak in Texas and New Mexico, mostly among children and teenagers. Medical contributor Dr. Celine Gounder says 50 and 60-somethings may be at risk, too.
People born after 1957, but vaccinated before 1968. That group is unlikely to have robust immunity from
less effective vaccine, she says. This is CBS News. A terminally ill man who spent over 30 years on Louisiana's death row has died.
81-year-old Christopher Sepulveda was scheduled to die on March 17th as part of Louisiana's effort to resume executions using nitrogen gas. According to the State Department of Public Safety and Corrections, Sepulveda died over the weekend at a Louisiana state penitentiary. He was charged with the 1992 killing of his 6-year-old stepson. His attorney said in a statement that doctors recently determined Sepulveda was terminally ill and recommended hospice care. Steve Kathan, CBS News.
Officials in L.A. are warning people to steer clear of public beaches because fire debris is washing back up on the sand from Malibu to Redondo Beach. They say it's a mix of ash, sand, and pulverized flecks of burned wood and plastic. Testing ongoing for now. They say it's not hazardous. Deborah Rodriguez, CBS News.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Monday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We are streaming as well, so head over to youtube.com, search Bloomberg Podcast Live. Alex Steele is back. Tucker's here. We are at full strength for the first time in a long time. Got a good lineup today. Oliver Crook, Bloomberg European correspondent, and give us the latest reporting on the elections coming out of Germany. Kathleen Quirk, President and CEO of Freeport McMoran. I once sold a liquid yield option note to Freeport McMoran back in 1990. Zero coupon convertible debt, $500 million deal we sold them. That was very nice. Matthew Palazzolo, Bloomberg Intelligence Senior Insurance Analyst. What's Warren Buffett doing with all his cash? They just reported earnings a couple of days ago, so we'll get the latest there. Victoria Fernandez, Chief Market Strategist at Crossmark Global Investments, will give us her market thoughts. So we got a lot coming up in the next couple hours. We're going to kick it off with Mr. John Tucker and a Bloomberg Business Flash.
And this Bloomberg Business Flash being brought to you by IBKR. Will the U.S. CPI exceed 2.4% in March 2025? Trade your prediction with IBKR Forecast Trader. The yes was recently at 60% by yes or no. Earn $1 if you're right. Go to ibkr.com/forecast. Will the major averages, they have now turned lower. The S&P 500 being led lower by tech. You have Microsoft shares, the biggest laggard in terms of the index points. Right now, Microsoft shares down 2%. So Friday registered a 1.7% sell-off for the S&P 500. The tech-heavy NASDAQ, it was a 2.2% decline. The big event this week, NVIDIA reporting earnings after the close of regular trading out Wednesday. Apple shares, right now, they are higher, up about 0.9%. The iPhone maker saying it's going to hire 20,000 new workers and also produce AI servers in the U.S. Well, after Friday's sell-off, Callie Cox at Ritholtz Wealth Management is advising investors buy the dip.
You know, I think it's a confusing environment right now. Earnings obviously are growing at a quite strong and underestimated rate at the moment. You know, sentiment is looking a little shaky, which to me is a good sign. You know, you don't have as many investors being blind to risks.
Right now, the S&P 500, 34 points lower. That's down 0.6%, 59.79 on the index. The Dow, 64 points lower. The NASDAQ 100 down 228 points. This is down another 1%. Starbucks news, eliminating 1,100 corporate jobs, trying to speed up the turnaround. At the same time, they're removing some less popular drinks from the lineup. The beverages getting the axe include several frappuccinos, the Royal English Breakfast Latte, and the White Hot Chocolate.
Basically, it's a lot of the stuff my daughter likes to drink.
Yeah, I don't know. What does that cost? Like one of those, the Frappuccino, for instance.
Oh, she didn't do the Frappuccinos, but like she likes the peppermint white chocolate one. I don't know, $6. Yeah, no, it's crazy.
For coffee. Anyway, we check the
No, it's
markets.
a lot more than that, because my little double short mocha is like $6. And that's just a little thing.
And you're willing to pay that?
I do once a week. It's just a little one-off thing on the weekend.
Okay.
I mean, you know, to each his own.
Yeah.
No
I'm
judgment
not a coffee
here.
drinker.
No judgment
Oh,
here.
no, I'm judging.
Yeah, no, but I'm telling you not to. Good luck with that.
That's your market update.
Well, it's great to see you guys. Happy Monday. Alex Steele here alongside Paul Sweeney and John Tucker. All right, let's get more on the market here and some individual movers. Vince Signorella, Bloomberg macro strategist, is joining us now. All right, individually in the stock market, what are you looking at, Vince?
Well, you know, it's really interesting with Microsoft rolling over, saying they're going to pull back on AI data centers. It's not overall changing their strategy, they say, but yet they're pulling back on some investments. So you have to wonder, is this taking the cover off the whole AI situation? Are people getting too excited about it, too much investment and not enough return to make that worthwhile any longer? We're seeing the NASDAQ lead the losers this morning, rolling over from the green into the red. I think that's got something to do with it, down about 0.9%, but I don't have my glasses on. I kind of was a little bit confused at the excitement of buying this morning. It looked like just what you were saying, more of a buy on the dip situation. But it doesn't look like it's lasting. Dow's gotten back to a little changed, but the other two major indexes still in the red.
So what's the talk out there in the marketplace here today? We're going to have a lot of economic data this week. Vince, earnings are pretty much over, although we do have a big one, NVIDIA, Wednesday after the close. What are people focusing on?
You know, I think we're looking at, and it's a little bit of a surprise, but we're looking at the sentiment data rolling over. And a lot of traders don't like to bet on the sentiment data. They'd rather bet on the hard data, the real data. But consumer sentiment is important when you're seeing inflation sort of stop going lower, if you will, and possibly picking back up again. Inflation in reality is a psychological event. It's created by sentiment. It's created by what people believe is going to happen. And if consumers think prices are going to go up and the economy is going to slow down, they change their buying habits. And that does affect the real hard numbers. So I think we've got some more data coming out this week in that respect, and we'll see how that plays out. But I don't think there's a lot of confidence out there in investors at the moment, at least the guys I'm talking to, but that we may have peaked a little bit in some of this equity surge.
Yeah, and also, in terms of that, do you feel like we're in a growth scare scenario or still a higher inflation risk scenario?
I think a little bit of both. I mean, you get the higher inflation risk scenario and you see people pull back on spending, and that affects the growth scenario. So it's a little bit of both, but I think it's probably led more with inflation. That's the first step. That's the chicken before the egg, if you will, and then the earnings will follow.
All right, Vince, thanks a lot. Really appreciate it. Good to see you. Vincent Signorella, Bloomberg macro strategist, joining us there. Talking about the market, what's so interesting is any gains in the euro versus the dollar that we saw have kind of been wiped out after the results of the German election. The bond market not doing that much either. A little bit of buying in the front end, a little bit of selling in the back end, but nothing too extreme. And this is after German conservatives still face a narrow path to power after victory. We wanted to get more here and the individual details with Oliver Crook, Bloomberg Europe correspondent, joining us now. So this was an election in Germany that captured the minds and hearts of the globe, right? This was super indicative of where the power shift will happen in Europe. What did we learn?
Yeah, so listen, Alex, and what we got in terms of the actual results of the election were pretty close to the polling that we'd seen for the last 4 months, and basically polling that didn't change dramatically between November and yesterday. And basically that was with the CDU, the sort of Merkel's traditional party, the Conservative Party, led now by Friedrich Merz, taking the #1 spot, getting 28% of the vote. Really, they were expected to get about 30% of the vote. I was at the headquarters last night, as those numbers dropped. There wasn't a huge amount of euphoria and excitement. They did a bit worse than they had anticipated. And of course, the sort of mainstay of this election campaign, and that made it really very distinct from other German elections in the past, is the fact that the far right, the AfD, was the #2 party. They got about 21%, making them the second biggest party in Germany for the first time since the Second World War. And it's the first time that that party ever put out a chancellor candidate. And that has really been the sort of drumbeat to which the whole political discussion in Germany has been. It has been really an agenda set in large part by the far right, and basically the mainstream political establishment trying to sort of vie and figure out how to sort of deal with that as they see it as a threat. And of course, they sort of managed to maintain the firewall. It seems as if now we're getting into the point where we begin the coalition negotiations in the Bundestag. That's just the building right behind me here. And that is where the sort of difficult path will be found for Friedrich Merz, because right now his really only possible partner for a coalition is the SPD, the center-left. This is Olaf Scholz's party that has just sort of basically had the worst result in the party's history. And at the end of the day, there are going to be very tough negotiations for these two mainstream parties, and it was not clear that there is a willingness right now for these two parties to compromise on the things that, frankly, Germany really needs to get moving here. They say they're going to get a government in place very quickly. Very quickly in German political terms means in the next 2 months.
So let's assume that happens. Friedrich Merz is able to get a coalition with the Social Democrats. Will that coalition be able to effectively govern, or has the far right become so strong that there may be gridlock?
The issue that Friedrich Merz faces is that basically he has no other potential partner as a coalition. He could certainly make a majority with the far right, but this is something that he has always ruled out, and that basically any mainstream party in Germany has basically permanently ruled out. So really his only option right now is with the Social Democrats, and the Social Democrats are in a position where they have done so poorly in the polls, though they've still maintained about 15%, that they basically don't have a whole lot to lose. So they may fight quite bitterly to try to get some of the things that they want to maintain. They don't want any reform to pensions. They don't want any weakening of labor laws. They want to make sure that the welfare state really stays intact. And that really goes at odds with what the CDU wants, which is basically to cut taxes, to try to make the environment a bit more friendly for business. Of course, there's the other question, and this is the perennial question, I think, whenever we talk about economics here in Germany, is whether or not this is a government that will be able to or willing to loosen the debt brake. It is, I think, fairly well established that they're going to have to set up at least a special fund which will let them make some sort of off-budget purchases for defense, for just defense spending. Are they willing to go further? I mean, many of the CEOs and the different lobbying organizations for the different sort of industries within Germany that I speak to are really sort of skeptical about basically the fact that these sort of mainstream parties are really grasping the severity of what Germany is up against here and really willing to kind of think outside the box and get these things moving.
Well, to that point, here in the U.S., our election was very much about inflation and immigration. What was this election actually about?
So listen, I think it's been about the economy. Inflation has been a huge story across the world, as you know, but certainly in Germany. I mean, again, Germany is now facing potentially a third year of contraction, right? The last 2 years of the economy has contracted, and that comes after really kind of decades of very strong German growth and a very positive economic story. And listen, at the end of the day, no country likes to get poorer, certainly not a traditionally very rich country that's been able to sort of grow very prosperously. And of course, there's also been this question of immigration, the sort of open door policy of Angela Merkel. There were, of course, more than 1 million people came from Ukraine after the war there, and that has been one of the sort of main sort of public issues that has really dominated the election. Again, now the CDU has sort of tacked to the right on the immigration question in order to try to take the legs out from under the AfD, but frankly, that did not work very well. The AfD, if anything, did a little bit better than had been anticipated, so this may not be the election where the AfD rises to power in Germany, but everybody I speak to, really thinks that the next one around, they might have a real shot.
Oliver Crook, thank you so much for joining us. Really appreciate getting your expertise. Oliver Crook, European correspondent for Bloomberg News. He was, as you mentioned, right in front of the Bundestag, which is Germany's parliament in Berlin, Germany. So we have boots on the ground like we tend to do as a global news organization. So covering the German elections, which were certainly front and center over the weekend, not just for Germany, but certainly broader Europe and globally in a lot of cases, because Germany obviously is a huge exporter to a lot of countries around the world, most notably China. S&P 500 off 10 points here. The Dow off 65 points. I'm sorry, positive 65 points. A little red and green there. The Nasdaq's taking on chin today, off 120 points at 0.6 of 1%. Coming up, we're going to have some more smart conversation. We're going to talk to Kathleen Quirk, President and CEO of Freeport-McMoRan.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. We're being brought to you by Oracle. Attention, growing businesses. Oracle is offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure. This is for new U.S. customers with minimum financial commitment. The offer ends March 31st. See if your company qualifies at oracle.com/Bloomberg. After Friday's sell-off, the Nasdaq adding to its losses right now. It's off the worst level of the session, but still down. The tech sell-off includes shares of Microsoft. They are pulling the plug on an AI data center leases. Investors now waiting for NVIDIA to report, and we get those results after the close of regular trading on Wednesday. S&P 500, 11 points lower. That's down 0.2%, right at 6,000. The NASDAQ 100, 149 points lower, and that is down 0.7%. Right now, the Dow Jones Industrial Average up 66 points, and that is a rise of about 0.2%. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Paul and Alex.
All right, thanks so much, John Tucker. Alex Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. Happening right now in Hollywood, Florida is the BMO Metals Conference, a metals and mining conference. I used to go back in my day when I was covering gold. It's really cool. You get to talk about metals. And we're lucky enough to talk now to Kathleen Quirk, President and CEO of Freeport-McMoRan Copper and Gold. Kathleen, it's a sincere pleasure. If I take a look at your stock versus the copper price, you usually track each other. In the last couple months, that hasn't been the case. Is that a demand issue? Is that a supply issue? How do you explain that?
Alex, it's good to be with you, and you need to come back to Hollywood. This is a great conference. In terms of the stock price and the copper price, we've seen somewhat of a disconnect in recent weeks. I think there's some concern in the market about China and about the trajectory of copper prices as we go forward. So there's some risk that people are discounting the current copper price. But as we look at the situation and look at copper demand going forward, copper, as you know, is the metal when it comes to electrification. And we're looking ahead at all of the build out that needs to take place in energy infrastructure, not just in the U.S., but around the globe. China's already been doing it, but we're starting to see it taking place in the U.S. and other places. It's very copper intensive. And we see a situation where demand for copper is going to be faced with a secular uplift, opportunity for growth in copper unrelated to cyclical drivers. So we're actually really bullish about where copper is today and what the likelihood for increases are for the future.
Kathleen, I think so far every S&P 500 CEO on their conference call has been asked about tariffs and the impact on their business. What will a rising tariff regime potentially mean for your business?
We're following it very closely. We're looking at it, trying to understand exactly what degree of tariffs will be imposed. No one exactly knows what it will be, although companies are preparing for it. Freeport operates all over the world, but we have a significant operation, significant presence in the U.S. And actually, we're integrated in the U.S. We not only have mines that produce copper, but we also have a smelter that processes our copper. So we don't have a need as a company to import copper from other countries. Copper is imported into the U.S. Because there's not enough current supply of copper to meet the demand. But from a micro standpoint, as we look at what the market is pricing in for the impact of tariffs, actually the U.S. price of copper, when you look at where U.S. Commodity prices are today and copper prices are today, the U.S. price is something on the order of 25 cents per pound higher than copper that's priced on international markets. So actually for Freeport, we're actually receiving for the copper that we sell in the U.S., we're actually receiving a premium to copper that we sell out of, say, South America or out of Indonesia. So it's actually right now in the short term, a benefit for Freeport, several $100 million a year potentially. But the thing that we're watching, and the thing as we've talked to investors and other business leaders, is the impact, the potential impact of tariffs on global growth. China is a big consumer of copper, consumes likely above 50% of the market. And so an all-out trade war could impact global growth. It could impact copper prices. It could impact, say, manifest itself through a strong dollar, which also impacts commodity prices. So we're watching those macro issues, but in terms of the on the ground today, we are getting a premium for the copper that we sell in the U.S.
We have about 30 seconds, and then you have to run to an investor meeting. So in 20 seconds, what do you think the copper price is going to do this year? If we take a look at the LME, are we looking at 10,000, 12,000?
You know, it's very difficult. We're not in the business of predicting short-term prices, Alex. As you probably know, we're in the business to control our costs, to invest wisely and prudently. We have a very positive long-term outlook for copper. You can't replace copper today for $4 a pound. We need higher prices in the future in order to invest in the business and generate the growth and demand, growth and supply to meet the expected growth and demand. So we're very positive on the long term, but the short term is difficult to assess.
All right, Kathleen, we appreciate it. Please come back when we all have more time. We'd love to break down some more stuff with you. Kathleen Quirk is president and CEO of Freeport-McMoRan Copper and Gold. All right, apparently there were some Berkshire Hathaway earnings. What is that cash pile now?
I don't know. It's
big
and getting bigger. Yeah, so Warren Buffett, Berkshire Hathaway reported some numbers over the week, and they do it on Saturday. Why Saturday? Because he's Warren Buffett. He can do whatever he wants. Matt Palazzola, he pays attention to that stuff. Bloomberg Intelligence insurance analyst. So, Matt, what were some of the highlights coming out of the Berkshire Hathaway earnings this Saturday?
So, big earnings jump from the year ago due to their most exciting and best business, in my view, the insurance business. We've been probably talking a while about auto insurance prices going up. And that is really showing through in the results of auto insurance companies like Allstate, Progressive, and Geico at Berkshire. So that was one of the big drivers. Another one was their investment income. So they've been selling a lot of stock. As you said, their cash pile, which is $334 billion, going up and up. And the investment income on that rose dramatically as well.
So how much cash does he have now?
So it's $334 billion in cash. That's just cash.
That
not
hurts
even
my tiny little brain.
Yeah, I mean, good problem to have, right?
Especially when rates are going up.
Yeah, I mean, and what has happened is...
So true. Oh my God, can you imagine? Yeah. Put that in a markets fund, what you're throwing off.
So they're getting about $11 billion in investment income a year just on their fixed investments, and that's incredibly short-term, T-bills.
Right.
Stock's up 10% year to date, hit an all-time high here today in intraday, so pretty good. The reality is the problem, if there is a problem, and it's been this way for years, and there's just nowhere to put that money. I mean, to find something of that scale is almost impossible.
Yeah, he talks a lot about that there's not much they can do to move the needle on results. They bought Allegheny a couple of years ago. That was $13 billion. They've put, I don't know the exact number, but several billion into these Japanese trading house investments. So they've been putting money to work, but none of those really move the needle. And they sold a ton of Apple stock. They sold, in the fourth quarter in particular, they sold a bunch of Bank of America stock, which we knew was going to happen. So there weren't really any other surprises as far as stock moves. They bought Constellation Brands, which is, makes beverages. I don't know all that much about them. They put about $1.5 billion to work at that.
So what does Warren Buffett say about the market being overvalued or not? And what does he say about, say, AI trade?
Probably not much. He didn't say, nothing that I've heard, Warren Buffett in interviews or anything. We've got the annual meeting coming up in May. So I would be shocked if he doesn't get one question on AI, at least at this point. They're not huge investors in tech names, obviously Apple notwithstanding. The investment managers might be more interested in stuff like that. And he had said in his annual letter it won't be long before Greg Abel's the CEO, so he kind of always acknowledges that and kind of more building towards the future.
So if I'm buying BRK today, Berkshire Hathaway, what's my investment theme?
Yeah, it's tough because in the earnings, I didn't see a lot of things that were, telling me, these are positive signals for the future earnings of Berkshire necessarily. Berkshire's got a huge retail ownership, so there's kind of some of that moves it. The fact that the earnings beat by a lot What didn't impress me, you know, we knew about Geico improving. They also had a lot of insurance favorable loss reserve development, which means they sell the business, their claims come out later, so they don't know the claims. What happened is their claims turned out to be a lot better. But in the third quarter, they had adverse development. So the things that pushed their earnings were not too impressive. The operating businesses like the railroad had a one-time comp expense in it. It seems to me like earnings probably will not grow in 25 just because of these items in insurance. And even the other underlying businesses, it'll be modest, if much growth at all.
So because I'm me, I'm really into Warren Buffett's stake in Oxy.
Mm-hmm.
So it's an oil company, but they're also doing a lot of direct air capture, and which basically you get carbon out of the air and you put it in the ground. But the reason why he has this stake that he continues to build, but originally it was when Oxy was buying Anadarko and they needed some funding and they needed it fast, and so he got a sweetheart deal. The rumor always is that, oh, he's going to buy the company.
So he flat out said, I'm not looking to buy the whole company. I think it was at the last annual meeting.
Yeah.
And I was writing the day before, maybe they'll buy Oxy.
Okay,
and,
fair enough.
So then he came out and literally threw cold water on it. They did buy more stock in the fourth quarter and the first quarter. And like you said, Alex, he made a very typical Buffett deal. Like, this is a company that desperately needs cash. We're going to get a great deal from them. But he has repeatedly talked about the management of the company and how he likes how they're positioned. So I don't think it was, it wasn't just taking that sweetheart deal. He does like the forward look of the company. Also, Greg Abel, the future CEO, is an energy guy. So I assume he played, a big role in that whole deal.
What about this Abel guy? Do we like him? We've now had a few years to get to know him, right?
I think we like him. We don't know a ton, honestly. Like, Buffett has him with him in interviews. He has him in the annual meetings. He will be there again. I think they said it in the report. He'll be there for, I believe, most of the time with Buffett. Mostly what I'm going on is how Buffett talks about him. Talks about him in terms of capital allocation. He always praises his managers. One thing I think you could point to is that Abel has taken over a lot of the day-to-day. So a lot of the managers of the companies Berkshire owns call Buffett, and he's kind of nicely, gently passed them on to Abel. If things are going well, they're probably going well due to Greg Abel's effort.
All right, Matt, thanks so much for joining us. Matt Palazzola, senior analyst following all the insurance stuff for Bloomberg Intelligence, is joining us live here in our Bloomberg Interactive Broker Studio. Warren Buffett, 94 years old. Greg Abel, a sprightly 62. So how about that? We'll have more coming up. This is Bloomberg. Good morning.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. And right now, the major averages, they are mixed. The Dow Jones Industrial average 30 points higher. The S&P 500 down 19 points. That's a decline of 0.3%. And the NASDAQ, after Friday's 2.2% slide for the NASDAQ, technology shares continue to drag down the index. Shares of Microsoft leading the declines right now. Microsoft shares are down 1.7% as compared to some of the earlier losses. In the U.S. this week, the Federal Reserve's preferred measure of inflation, core PCE, that is set for release on Friday. Meantime, Nella Richardson, the chief economist at ADP, says, sentiment around the job market that appears to be faltering.
There's a sense that the economic prospects, the job opportunities aren't as plentiful as they were 2 years ago. It's taking longer to get a job. It's taking longer to find a white-collar job. We've seen business services retract their hiring.
And earnings, of course, this week, the big one, NVIDIA reports after the close Wednesday. Here's some research from BI. Stocks significantly underperforming the rest of the world in the U.S. nearly 2 months into the year. Bloomberg Intelligence, Gina Martin Adams among them, writing it's a rare and historically significant red flag against a full-year recovery as the market's fundamentals deteriorate. Once again, the S&P 500 21 points lower. The NASDAQ right now down about 1%, 188 points lower. And we check the market's view all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Paul and Alex.
Thank you so much, John Tucker. Alex Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance through our lens of our Bloomberg Intelligence folks. They cover 2,000 companies and 130 industries worldwide. We go now for a broader view. Victoria Fernandez is Chief Market Strategist at Crossroad Global Investments, and she joins us now from Houston. Victoria, buy the dip has been the norm. Then there's been chattering that buy the dip won't last and that we're on borrowed time for that. Where do you stand on that?
Yeah, I think it depends, Alex, on the size of the dip that we're looking at. When we have small pullbacks that happen just in regular volatility due to the uncertainty around whether it's going to be Fed policy or whether it's fiscal policy, and those are going to be things where I'm not sure you want to jump in and start buying a lot of names. But I do think that as we go through the first half of this year, we probably will have a chance as there will be a more significant pullback. I'm not saying we're going into recession by any means, but I do think you're going to see things start to pull back, probably led by maybe weaker earnings as we get the first quarter earnings of this year. We see those slow down. We see the labor market slow down, consumer spending slow down. That, I think, then is going to be your opportunity to go in and find those areas within the market where you have seen sectors start to struggle and maybe form a trough and on their way back to have upside trends. That's where you'll want to go in and start buying.
So, Victoria, you mentioned earnings were about a little more than 80% of the way through the fourth quarter earnings there. What are your takeaways from those earnings and maybe from the guidance?
Yeah, so, Paul, surprisingly, earnings have been really good for the fourth quarter. I mean, we're looking at 15% earnings growth, 5% revenue growth. I think energy is really the only sector where we have seen negative growth as a whole for the sector. So really strong there. And I thought we would have started to see some of the effects of the higher rates that we had throughout 2024. I thought we would see some of the effects of the labor market weakening start there, but maybe it's getting pushed in to the first quarter earnings as tariff concerns pulled forward a lot of elements into the fourth quarter of 2024. So strong earnings, and I think that's why you saw probably the S&P hit a high last week, because that animal spirit is still running high due to the earnings and that support to the economy. But that's probably going to start fading away. We saw it at the end of last week. I think we'll see some more of that over the coming weeks.
Yeah, and speaking of, this is from Bloomberg Intelligence, just talking about earnings. Apparently, companies that guided higher on profit and sales have outperformed the S&P by 6.7% within a day of posting results, the most since 2020. I found that to be really interesting. I hadn't noticed the disparity effect there. So, Victoria, though, despite earnings, we have seen rotation into European equities. Do we think that that actually continues, or the U.S. exceptionalism theme reigns?
Yeah, I'm not surprised that we've seen this switch. I mean, I know all morning long we've had the conversation around valuation, right? And if it's still something that people are looking at, clients aren't asking about it. You talked with Bob Dahl, my CEO, Mike Wilson earlier this morning talking about that. But valuations in Europe are much lower than what we're seeing in the markets here. So I think as investors say, where can I get maybe a bigger bang for my buck? And you're looking at that valuation number, Europe makes sense, especially in the financials. Financials are doing well globally. So it gives you an opportunity to get in there. And you also have to start thinking from an FX perspective, what that's going to look like. Are you going to see continued rate cuts from the ECB? And what does that mean for the euro? And what kind of carry trade we're looking there? Obviously, the yen carry trade, people are starting to watch once again. So I think there's a lot of different factors, but it wouldn't hurt to kind of dip your toe a little bit internationally, even though I still think globally you'll see the U.S. over time continue to be the strongest economy.
Yeah, I'm glad you brought up international investing, because I'm just looking at an email I got from Torsten Slock from Apollo this morning, talking about the market capitalization weight, how the gap between the U.S. And the rest of the developed world is widening, so that concentration in the U.S. equity markets relative to the rest of the world is just getting more and more. To what extent is that a concern?
Well, concentration is always a concern for us, Paul, because you don't want to, to use the old phrase, you don't want to put all your eggs in one basket. What we're starting to see in the U.S. is some of those elements where all that concentration was, those Mag 7 names, you're starting to see pullbacks in those names, and hopefully we will see things broaden out. But it really hasn't been as strong as a lot of people thought it would be when you're looking at the other 493. I mean, you look at the S&P making its high last week, but the advanced decline line for the New York Stock Exchange did not meet it and go to a high like that. We're still only seeing about 53% of the S&P above its 50-day moving average. So we're not seeing that broadening out that we'd like to see for a sustainable move higher in the markets. We'll continue to watch that, but we really want to see that concentration start to diminish a little bit and have more of a widespread uptrend in these names.
Does any of that include, say, small and mid caps?
Well, we would hope so, right? Small and mid caps is really kind of what will tell us, yes, we have found our footing. We're feeling better. We like what's going on. But look, we've seen yields move lower, even though inflation expectations have moved higher. So to me, that's saying, okay, wait, these are growth concerns that we have right now. If growth and the concern over a lack of growth is what's pulling yields down, that's not going to be great for small and mid caps. And we also have to look at the fact that, we're hanging in around that 440, 450 level on the U.S. 10-year. We've got about a third of all corporate debt in the U.S., small, mid, and large cap, coming due over the next 5 years. That's going to be a concern for those small and mid caps when it comes to refinancing. So we'll have to see what happens there. But for right now, I think we continue to wait on some of those small cap names until they get some better footing and we see the economy on its way back up.
Victoria, 30 seconds. What's the fixed income call here?
Well, look, we've been doing barbell strategies in our fixed income portfolios, really wanting to capture some of the higher yields on the shorter end as we think the Fed stays higher longer. That keeps those short rates higher. And we have seen inflation push the longer end up as well, although over the last couple of weeks, there's been a flattening. So I think maybe lock in a little bit of these rates on the longer end, take advantage of the short end, and we'll let the belly of the curve adjust to the volatility that we've seen.
Victoria, thank you so much for joining us. Always appreciate getting a few minutes of your time. Victoria Fernandez, Chief Market Strategist for Crossmark Global Investments. She's based down there in Houston, Texas. close to the oil patch, which is where I hang out in West Texas.
Yeah, that's when I first met Victoria. When I was broadcasting down there for an oil thing. We talked about oil stuff.
Cool. Yeah, absolutely. So we'll keep an eye on that. Speaking of oil, WTI crude oil, it's up just a couple of pennies here today, but $70.58. It did earlier in the session get right below 70, 69.80. So a little bit of downward pressure over the last several days for crude oil. We'll have more coming up. This is Bloomberg.
Listening to Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, Alex Steele, Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. So you can head over to youtube.com, search Bloomberg Podcast Live, and that's where you will find us. Anurag Rana joins us. He's a technology analyst from the burgeoning tech capital of Chicago, Illinois. Lots to talk about, a lot of news out there, Anurag. I want to first start with Microsoft. Some chatter out there in the marketplace that Microsoft is canceling some data center expansion leases and concerned that that may suggest a slowdown in this whole AI spending thing. What do you make out of that?
Yeah, I think if you go back to the day after the inauguration, you had OpenAI, SoftBank, and Oracle, come out and say we're going to spend $500 billion over the next 5 years with $100 billion in year one. We also heard before that OpenAI and Microsoft was having some problems about OpenAI wanting more Microsoft resources for testing their newer models, what in our world we call training, and Microsoft saying that, listen, I've been spending a lot more anyway. Let me focus on the inference side of it. I think a lot of this, what we heard a couple of days ago, stems from that particular aspect that Microsoft is saying, we have these money allocated for AI-related stuff. Instead of giving it to OpenAI, and this is my hypothesis, we can't tell for sure that's what happened. Mm-hmm. But we are looking at more towards what comes out of people using these tools on the inference side rather than training. So I think it's a reallocation of resources. But I can say that just 2 days ago, about 3 days ago or so, Microsoft CEO went on a podcast and said, I'll be leasing more in 27 and 28. So if that matters, I think he's sticking around with his CapEx numbers. I'm not seeing them going down. The question is whether he's going to allocate more towards training or experimentation versus workloads coming in on which he makes money. Basically, that's what generates revenue for him.
So that's the confusing part to me, is why the stock's getting hit so much. Because a couple weeks ago, you can make an argument that investors didn't like $80 billion of CapEx spend.
Yeah, I think the sell-off, has broadly to do with other things that are happening as well. If you look at the entire software space is down, even the companies that have nothing to do with AI workloads or inferencing. So I can't really extrapolate whether Microsoft is down because of that. But I think they made it clear that, from their side, they will be spending money. As an analyst or an investor, you should be happy that they are allocating money where they will eventually get AI revenue rather than, just giving it to OpenAI for experimentation reasons.
Apple news, going to make some big investments in the U.S. here, a new manufacturing plant in Houston. Is this response to political pressure? Is this a capital allocation move that you were looking for? What do you make of the Apple news?
I think historically, Apple has not been in this area of investing themselves to do some of these things. A couple of places where we have seen it is, they created their own chip. So that was an in-house project. It took several years. Then they have worked on with their in-house Qualcomm chip or replacement of the Qualcomm chip. Right now, for AI-related servers, they are really dependent on hyperscale cloud providers. But it seems to me from today's announcement that they're going to do some of that in-house because, Apple Intelligence is extremely important for them to sell their products in the future. If they want to take full ownership of it, I think they want to do it both from the supply part of it in terms of the servers and as well as the software part of it. So I think the bigger investments is going to be what I call as the high-end jobs, which is semiconductor manufacturing, AI-related models, and then AI computing. So this is where I'm seeing. On the good side of it, even if let's say for the sake of argument, he's doing it because he's been pressured by the president to do it. It can help him all on the regulatory side of it, where they're really getting squeezed on the App Store and some of the other fees that's happening there.
Do you think that this would have happened regardless of who was in the White House? I mean, that's a big chunk of change to commit.
Yeah, I don't think it would have happened without a lot of pressure to, get him to, you could say, get a concession on the tariff side of it. I think there is a little bit of extra investments because of the pressure of doing it in the U.S.
Anurag, we appreciate it. Thank you so much. Anurag Rana has to run to TV now. Bloomberg Intelligence Senior Technology Analyst joining us on Apple as well as Microsoft. I don't know, I thought the Apple stuff was really quite interesting because do you really make that kind of commitment off the cuff after meeting with the White House for 72 hours, or has this already been in your plan for a long time that you've built out?
Yeah, I don't know the answers to that, but because again, $500 billion over 4 years, new manufacturing facility, more employees in the U.S., but all in all, we'll see how it plays out. But I mean, again, big bets are still being made. That's clear in AI. Is a rate of change maybe slowing? Maybe we'll see from NVIDIA when we get their earnings after the close of Wednesday. That'll give you a good window on what's happening there.
So I guess Citi is looking for the options are pricing in a 7% move to the upper downside with NVIDIA, which I guess in comparison to normal NVIDIA earnings, isn't that dramatic, isn't that big of a deal. But it will still be quite interesting to see how it winds up moving. All right, just for your listeners in the U.S., here's a reminder. You can listen to us via satellite radio on SiriusXM channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on SiriusXM channel 121 is presented by Oracle. And stay tuned for the latest market news and industry research. All right, let's get a good market check in here because it is an interesting day. You're looking at tech getting hit the hardest with Microsoft as well as Palantir leading the NASDAQ lower, off by over 1%. Now, the S&P 500 is just down by 0.5%, and the Dow Jones Industrial Average is flat on the day. Now, what to look out for aside from tech is the volatility as we head into NVIDIA's earnings. Could be that first in a series of events that could impact the market. We also get inflation and U.S. consumer data data as well this week. And then the big question that everyone's kind of puzzling with, are we going to see a rotation from U.S. into European equities? Will the move there and the flows there continue, particularly as the data winds up dropping during the week? Also looking for any drawdown. Do investors buy the dip? That's the big question. Second hour of Bloomberg Intelligence starts right now.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Monday, everybody. I'm Alex Steele alongside Paul Sweeney and John Tucker. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance through our lens of Bloomberg Intelligence, folks. We have a great hour lined up for you. Mark Gurman, chief correspondent at Bloomberg for Apple, will break down that news that Apple's going to add about 20,000 jobs to the U.S. Press Brian Jacobson is chief economist at NX Wealth Management. He will break down his outlook for the market, inflation, and the labor market. Michael Halen will join us. He's from Bloomberg Intelligence on Starbucks, cutting 1,100 corporate jobs and apparently all the drinks my daughter likes to drink. I don't know what that means, but there you go. And also we will break down Max Chafkin is Bloomberg Businessweek senior reporter about Musk dividing the Trump administration. We'll break that down for you. But let's start it all off with a Bloomberg Business Flash. And for that, we go to John Tucker.
All right, major averages right now, they are, let's call it mixed. The Dow Jones Industrial Average up 16 points right now. The S&P 500 is down 21 points. That's a decline of 0.4%. The NASDAQ 100, that's the big decliner because that's where technology is, down right now 0.9%. That's a 184-point sell-off. And this comes after Friday's 2.2% decline for the NASDAQ. NVIDIA, Microsoft, laggards right now in terms of the index points. And, of course, Wednesday is going to be NVIDIA's first profit report since DeepSeek upended the AI industry. It's worth noting Alibaba's stock right now. Those shares, they are the e-commerce giant, down right now 10%.
What?
And I'm looking for a reason for that. They are going to spend more than $52 billion on artificial intelligence and cloud infrastructure over the next 3 years. The spending will top the company's AI and cloud computing investment over the past decade, but that's the only reason I could see.
Stock had been moving really higher, so some profit taking maybe on
that is a distinct possibility. Meantime, Bob Dahl at Crossmark Global says Friday's stock sell-off, that was probably justified.
The potential for a growth scare is sadly for real. It's retail sales, it's housing starts, it's manufacturing production. The University of Michigan a survey, all of these things are saying, in just a second or two, we've had some pretty good growth over the last few years. Maybe we're going to take a little pause here.
Quick look at Berkshire Hathaway. That is up 4.1%. Climbing after they reported a jump in operating profits for the latest quarter. Also sitting on $334 billion of cash. That could indicate he doesn't see a lot out there that's worth investing in. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Alex and Paul.
All right. Thanks so much, JT. Appreciate it. Alex Steele, Paul Sweeney, Bloomberg Intelligence. All right, let's get to some of the stock movers here, individual names that are moving. And for that, we go to Denisa Sekova, Bloomberg Cross Asset Reporter. What are you looking at today?
Let's start with Apple. Obviously, it was one of the biggest movers today. It's one of the few tech companies that it's still in the green, despite the gain is much smaller now. But we saw it rise more than 1% earlier today. Of course, it's coming on the news that Apple is hiring 20,000 workers in the U.S. This is their biggest U.S. commitment so far. It's $500 billion over the next 4 years, quite significant amount. Of course, it comes just a few days after Tim Cook met with Donald Trump in the Oval Office. Of course, the context is the additional 10% tax on items imported from China, which of course was floated by President Trump. And the investment is throughout the U.S. We're hearing about manufacturing facility in Houston, supplier academy in Michigan, and we're seeing a positive reaction from Apple, which actually is down year to date. We know that Magnificent Seven has been struggling so far, and Apple is one of those names.
What else are you looking at?
We're looking at Nike, which is having Nike.
Okay, listen.
That's how the
European. In my head. It's always the European side of me.
That's the European pronunciation. Absolutely. Now
Nike.
I go with Adidas. I'll go Adidas.
Okay. I like Adidas.
I veto both of you right now.
You veto both.
Yeah. Okay. Go ahead.
Nike's up 6% today. Now it's a little bit less, but it reached 6% earlier, and that's coming after a very tough year last year. It was down 30%. There is a lot of optimism coming from Jeffries. Of course, they have a new CEO. Of course, they have a new campaign with Skims, which we saw last week was a very positive reaction to the stocks. And Jeffries is saying that the introduction of that campaign is set to revolutionize activewear market, so really big thing. And Nike has put renewed focus on women. We saw their first Super Bowl ad in a few decades. So for sure, the focus on women, the growth, all those collaborations are bringing a lot of optimism to the stocks that has suffered for some time.
I have to be honest, I loved that Nike Super Bowl ad. I totally got chills. I was really into it.
Okay.
That was just
That's what they're going
super
for.
awesome. They totally had me there. All right, last thing you're watching?
Domino's. Some bad news from Domino's. They were down as much as 7% in earlier trading. This was their biggest intraday sell-off since July. That comes, again, after the restaurant operator reported U.S. same-store sales that trailed Wall Street expectations. And again, we're going back to that theme of the U.S. consumer, which we've seen in economic data. We've seen all the analysts being worried about that. And we're seeing that Wall Street investors are very sensitive towards that. The report has some good news in terms of international sales, but the fact that the company lowered their goals in October for U.S. and the fact that they mentioned consumer spending, obviously